Healthineers and Philips on the news that China is taking some reciprocal action targeting them in the Chinese market. Chrissy.
It's a fascinating one as well. You talk about the medical device makers. You named a couple there. I'm curious to see how it shows up in the broader index, though, as well. If you're concerned about concerns between, or tensions, I'd say, between Beijing and Brussels, does show up in the likes of the CAC, for example, that luxury exposure to China. Well, here we go. We're going to find out. It is 8 o'clock. That does mean the European markets have opened across the continent and right here in the UK. Right out of the gates, the FTSE 100 kind of wobbling around. You're not seeing much kind of momentum in either direction. Flat at the moment. Still waiting for the others to be opening as well, though. There is a question here, as Stock 600 kind of following the same dynamic that the FTSE 100 is. There is a question here, what matters more, the trade agreements that we are seeing or this idea of tensions with China? Remember, the European markets have exposure to both sides of the world. We'll kind of see how that kind of read-through shows up this week as well. There's also a question here of light volume, light liquidity. It is, after all, a European summer. Does it show up in some of these market moves or lack thereof? I'm going to kind of hand it over to you, Val, because simply the most exciting thing on this board today is a 1/10 move to the upside from the French index.
Well, when we were looking at the sectors just here in the first minute of trade, we do see energy to the downside as expected after that OPEC supply increase. We also have healthcare to the downside, one of the worst performing sectors on the back of the China retaliation against the EU on medical device procurement. So that is showing up in the sector movement so far. In the top of the basket, we have real estate and consumer products and goods. Tom, what is it looking like on the individual movers?
Yeah, Capgemini, a company, of course, we mentioned on the back of that deal for WNS, 3.3 billion. Down 2%. They're going to be paying, it seems, a 28% premium for that US company to kind of build out their AI proposition. So Capgemini under pressure, but despite that, as you said, you're seeing gains in the CAC, just 0.1% across that index. We know that Shell is under pressure as well on the oil price moves. Not a huge surprise there. The surprise, of course, was the output decision from OPEC Plus. Not a big surprise that Shell and other oil majors, to your point, Val, is a little softer in the session, down close to 2% right now.
Yeah, we do see Siemens Healthineers on that medical device retaliation from China. Also to the downside, the eighth worst performing stock on the Stock 600, down 1.5%. So we'll keep an eye on how those medical stocks trade so far in the open, but it does seem like there is a weakness in healthcare.
Okay, let's get more analysis across these markets right now. Bring in Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Christian, great to have you in the studio as ever. Good morning. Thank you for joining us bright and early on this Monday. What are you expecting in terms of volatility around the trade story and how markets may be positioning? Are you comfortable with where markets are as we lead up to July the 9th?
I think there's been a bit too much relaxation. It feels like markets have shifted towards a bit of a Goldilocks regime where I think the data has been remarkably resilient so far, the hard data at least, and there's been very little impact on inflation. And there's this expectation that there's a lot of offsetting factors. Oil prices is one of them. There's this expectation oil prices keep falling into the end of the year. That's our view as well. But then you also have the view that housing in the US is very weak. So that's all going to offset the tariffs. But it also is based on the assumption that we know what the tariff baseline is now. But if uncertainty picks up on the tariffs and we start to see the first signs that in the hard data there's some negative impacts, I think the market might question that Goldilocks pricing that it currently has.
What is the Goldman Sachs view on when the tariff story starts to show up in a material way on earnings?
July. I think literally now, I think we will get in that earnings season starting July 15th, we will get companies potentially reporting first impacts, but more importantly, give guidance. And we'll learn if this is a relative value story where there's a few specific companies impacted, or if it's an S&P, if it's a beta story. And I think that's what we need to understand, because if you look at the implied correlation, like how the market prices volatility in the earnings season, is it micro or macro? The implied correlation that's priced is very low. So the market actually thinks it's going to be a micro story that's very specific companies, but it's not going to be a big macro factor. And if you start to see breadth in the impact in terms of guidance from tariffs, I think the market is not priced for that.
Yeah, Christian, on that, is there any specific sectors you're looking at specifically when it comes to how they're dealing with these tariffs around earnings season?
Well, you can imagine anything that's exposed to the tariffs in goods. I think retail is a very popular area to worry about. I think obviously companies that rely on the global supply chain, Apple is often mentioned. So anything you can hear from them kind of working in those tariffs that are increasingly clearer where they will come out at, or possibly a lower bound where they will come out at, they will have to give guidance to these companies.
Do you think we're going to get any hints on the tariff pass-through to inflation on next week's U.S. CPI report, or do you think that's still too early?
It is a bit too early. I think we might actually get more information in the earnings season. So our economists have an expectation of 70% pass-through to the consumer. So it actually is a very small pass-through to actual corporates. So if we do actually see a larger impact to the corporates, it might actually feed in this idea that inflation will not have as big of an impact.
Because they'll be taking the hit on their margins instead of passing it through to consumers. That makes sense.
Yeah.
What's the bigger hit, though? The hit on margins or suspension of buybacks, suspension of guidance? We're already seeing elements on both in certain American companies, at least. I feel like it has yet to hit Europe yet. But what's the bigger red flag?
I think to me the most important is margin and ROE. Like we've done a lot of work showing that U.S. equity valuations are very, very high compared to their own history, compared to other markets because of profitability, because of margins, because of return on equity. And if the market has any reason to start to worry about that superior profitability, even if it's just for a few quarters, I think markets might have to kind of reprice a bit.
But talk to us a little bit about what that incentivizes here, because even if you do see margins kind of compression, for example, in the States, it is still, from what I understand, a larger number, a larger profitability to your point than its European or even I would argue Asian counterparts as well. Do you start to see a weakness in the dollar incentivize a bit into the U.S. equity market that, as you put it, is expensive?
Yeah, I mean, listen, I think the U.S. margins, they're like at 20, like the ROE is like 21%. In Europe, you're looking at like 12, 13. So I think you have a major advantage as of now. And I think everybody is, because of the benchmark, somewhat overweight U.S. assets, somewhat overweight U.S. equities. So you're accepting that type of overweight when you have that superior profitability, that runway in the next years, that the U.S. exceptionalism continues. But if you do actually start to see signs of U.S. exceptionalism being questioned, I think the capital flow dynamic out of the U.S. Might continue.
But how much of that is simply a narrative shift as opposed to the numbers actually supporting it? You talked about a gap between of almost double, or when it was 23% and 12%, even a pullback to say, I'm throwing a number out there, I don't have the math on this, but to say 15% on margins is still better than its European counterpart.
No, 100%. And there's two things worth mentioning. First of all, you're absolutely right, so far it's a narrative, but we'll learn about that in the next earnings season in the coming month. And the second thing is, so far actually, the shift out of the US has been very marginal. Like most of the movements we've seen have been the dollar. If you actually look at the performance of US equities relative to European equities, there is no major underperformance anymore. It's all currency. If you look at fund flows, there was an element of repatriation in Europe, but globally, we've actually seen continued inflows into US equities. So I would actually say that, yes, it's been a narrative, but it's not been in the flows. So if the narrative does show up more in the flows, I think there's still more potential for US equities to maybe have a few setbacks.
Christian, you're just talking there about how a lot of the outperformance of European stocks has been more FX related. To that, guys, are you doing currency hedging differently this year than previous years?
No, absolutely. That's the big discussion. I mean, the big discussion is how do you manage, as an asset allocator, this U.S. asset dominance? Because we know diversification is the only free lunch in finance, according to Markowitz. So when you have 65% of the MSCI world in the S&P or U.S. equities, 40% of the Bloomberg Global Ag in fixed income in the U.S., you need to rethink a bit how to manage that U.S. asset dominance. So what we've been discussing a lot with clients is FX hedging. So like FX hedging in fixed income is quite common. But in equities, people usually run very low FX hedges. So there's much more rethink about that, because you have like nearly 25 to 30% of your portfolio risk being driven by the currency right now. That's the highest we've seen in a decade. So FX hedging is one way, but you have to consider that it costs. No, like there's a carry cost, especially for European investors. So there's a lot of rethinking. Like first you do the FX hedging, afterwards you need to think about portfolio shifts, and a lot of that hasn't happened yet.
Do treasuries look attractive in this environment?
Well, it comes down a lot to what happens with the tariffs, with inflation and the Fed. I think what we've been saying is that now with the Fed potentially cutting a bit more and a bit earlier, lower terminal rate, you can see the fiscal concerns also with the big beautiful bill now being passed or having been passed. The fiscal concerns are easing a bit. So you could say that treasuries are starting to find their footing a bit. But the problem is, of course, if the tariff impact on inflation comes back and the Fed needs to backpedal, at least temporarily, I think treasuries, unfortunately, are also a bit vulnerable. But we have a range-bound yield as a baseline.
Well, in terms of the range-bound yield, I'm assuming it's the 420 to 460 that we've seen in these markets. Does a compression of oil prices, which is largely expected by these markets, push yields even lower?
I think it will help. No doubt, we know the longer-dated break-even inflation tends to be linked to oil, so falling oil prices can help a bit in the back end. But I would say that it's not a huge relief that you can expect. No, I think the main driver for the bond market in the US is the Fed. And I think if the Fed does shift in a more dovish way, because the tariff impacts are smaller, coupled maybe with a new Fed chair next year that has a slightly different view about the fair level of rates, the neutral rate, I think these things are very, very important for bonds in the US. I think oil helps at the margin.
Christian, before we let you go, we had Vincent Mortimer from Amundi on the show earlier. He said when it comes to Europe, he wants exposure, but he wants to broaden out beyond some of the names that have benefited from the infrastructure and spending stimulus story. So beyond defence. Do you agree with that? Is there a broadening out of the European markets that can be taken advantage of?
I think as of now, definitely still a very narrow story. I think what we've seen a lot of clients focus on is factors. Like factors allow you to invest in Europe in a much more broad way. So, for example, the low volatility factor has been a very big focus where Europe has a lot of sectors, a lot of companies that in international portfolios can help. Banks have been a big focus. Obviously, defense and fiscal infrastructure have been a big focus. But outside of that, you actually have a lot of headwinds. Don't forget the strong euro is a major headwind for earnings. So coming into this earnings season, we will start to learn what that strong euro will actually do to some of the companies. So one has to be a bit more domestic as well. And domestic means usually less liquidity and less market cap in Europe.
All right, Christian Muller-Glissman, head of asset allocation research over at Goldman Sachs, joining the program this morning, covering a little bit of everything. We thank you so much. Let's get a quick check on the core six, the heavyweights, of course, that do move this European benchmark. It's kind of a meh kind of day. Novo Nordisk is the exception, though, down about 1.8%. This is, I think, crucial when we talk about some of the healthcare stocks. Remember, we did see a massive boost on Friday as well. The idea that there may be, big emphasis on May, some sort of carve-out, some sort of exceptions when it comes to the pharmaceutical market in the U.S.-Swiss trade deal. Something very specific to the healthcare story there, but you can see perhaps retracing some of the gains you saw. The rest of the market, I think Ferrari is the most exciting move there, higher by about 0.2%. Maybe Joe Easton has a little bit more drama for us this morning. Joe.
So one place that'll bring you some drama, maybe not so meh today, is the medical tech space. Getting hit today. We are seeing weakness in Healthineers, Philips and Carl Zeiss MedTech today. This, of course, coming from the news over in China over the weekend that the country is going to exclude some European Union medical tech companies from their procurement. That's a kind of retaliation against what the EU has been doing in terms of trying to have a bit of a hit back on the trade war on that sector. So we are seeing significant weakness in that market. Probably one of the only real exciting parts of the market, as Chris was mentioning, not too many big sector moves today. But Capgemini also a little bit weak. This coming from the news that they are doing a $3 billion deal in the US for WNS. Now, this is an AI company. They are paying quite a big premium, around a 30% premium on the long-term price on that one. So we are seeing some weakness. Potentially the price is too high, according to analysts and investors on Capgemini. So that one is weak. And another weak one today is Currys not selling enough TVs and dishwashers and that kind of thing. According to RBC, they are downgrading the stock today. This is on macro weakness, a general weakness in the UK economy feeding through into the consumer. So RBC cuts the stock, and that reacting pretty badly to that downgrade, down 6%. For that one today. Then over in the insurance space, over in Italy, we have got news of UniCredit selling down some of their stake in the insurer Generali, but that stock actually gaining. We did get an upgrade on Generali today from JP Morgan, probably taking the sting out of that news from the weekend. So Generali actually managing to rise. We're at 1.3%. On that one today, then Shell not looking very happy either. Most of the stocks we're doing today are pretty negative. Shell coming down, we're down 2.5%. We have had the oil price weakening today as well, so that's potentially feeding through. But Shell had their trading update looking pretty soft, all a little bit predictable given the glum outlook for the oil markets. They have given some pretty downbeat numbers on their production, as we've got on the bottom of the screen there. Then finally, Stellantis. This one has a very negative note out from Bank of America today, saying that it's going to be a very bad second half of the year for Stellantis. Well, that price has kind of let me down, hasn't it? Because I thought it was down a lot more than that. I'm sure Stellantis is actually down 3%. Well, I'll have to recheck my data on that one. Bank of America downgraded Stellantis. I'm guessing that's the US price there. The one in Italy, take my word for it, it's down 3% because Bank of America think they're going to have a tough second half due to electric vehicle competition, and the stock, take my word for it, it's down 3% in Italy this morning.
We can confirm, Joe. Don't worry. We believe you. Down about 2.8% as we speak on the Italian index. We thank you so much. Joe Easton from our equities team. Look, it's interesting that he's talking about some of the pieces that he mentioned. The medical equipment sector, the Shell story as well. A lot of this seems to be more of a macro-driven story than a fundamental kind of equity individual company story.
But yeah, we were worried that this week was all going to be driven by tariff headlines. It seems like for Monday, that's not true at the moment. We're still following the macro story.
And Christian Muller-Gleesman to that story, making a really interesting point on the macro versus the micro in terms of how the tariff story shows up, and that the markets right now are betting this as a micro story. Individual companies will be impacted, but at the macro and beta level, that's not going to happen. Yeah. He questions whether or not the markets are misplaced on that front. Coming up, as Trump prepares then to send out tariff letters to trading partners, it's going to happen today, he says. Will European luxury brands pass on the cost to consumers? We will have more on that. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB forum in Central Portugal, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What is
is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Good morning, welcome back to the opening trade. Happy Monday. We are, of course, 19 minutes into today's session. Broadly flat across the stocks 600, waiting for the next catalyst, and that is likely, of course, to be some tariff volatility. We had some news over the weekend, of course, and some question marks over whether the deadline is July the 9th or August the 1st. That is the picture then across these markets. The next catalyst is there being watched for. The DAX is up 0.3%. Over in France, the CAC 40 is flat, and the FTSE 100 here in the UK just down 20 points so far. Pretty.
Speaking of that tariff deadline, how the markets are pricing it in, let's talk about when European sectors are most exposed. Luxury immediately comes to mind. Tariffs as high as 31% on Swiss-made goods, threatening to significantly raise prices for American consumers. This dramatic shift could force luxury powerhouses to choose between absorbing the cost themselves and alienating loyal customers. Monitoring this trend is Carol Maggio, Barclays head of European luxury goods research, joining us around the table this morning. Carol, a pleasure to have you on the program. Thank you for joining us and making time for us. There is this big question about how quickly the margin gets hit. If the richest rich of the world stop buying into the luxury goods, is that a real risk, or are we overthinking it?
I think it is a risk to some extent. You know, when you think about the tariff situation, there are, to me, quite two kind of impacts. The first one, which is the direct impact, which will be, I think, quite small on luxury, P&L, because there's some high gross margin. You only, I think, touch a part of the COGS in the US, so it's quite, I think, limited. And I think, of course, the second impact will be the indirect impact on luxury spending. So basically, how the consumer confidence level is impacted by those tariff situations and the lack of, I think, visibility in the market. And that, to me, is the biggest risk out there for the sector. So the lack of clarity on consumer base could make them buy less, basically, goods going forward.
How much does the recent escalation between the EU and China, especially when it came to brandy last week, does that change any of your long-term thesis?
I feel like at this stage, not so much. It is still early stage, and we are seeing anyway some weaker demand for the Chinese consumer base for the past maybe now 1 or 2 years already. So we have to see how it evolves going forward. But the view that we are going to be seeing weakness in China for at least the rest of the year, and maybe some recovery in 26, and then going forward in 27, some return to growth. But right now, Chinese market is quite under pressure anyway. So we haven't seen much change on the back of this recent news flow.
So is that particularly around LVMH and brandy and cognac? Or is that a broader luxury story that it doesn't turn around in China until 2026?
I think it's a broader story. We are seeing Chinese consumer demand being quite weak across the board, being on a soft luxury, hard luxury, pretty much everywhere. There's some negative growth coming from the Chinese cohorts. So yes, we are to expect some weaker trends for, again, maybe 6 months or more across the luxury space.
What happens after those 6 months? I mean, is there a question here of investing in luxury as a buffer or as a store of wealth? Has that been a question, especially when we talk about things like depreciations in wider assets like the dollar, the stock market, arguably Bitcoin, if you subscribe to that? Do you see any sort of change in terms of approach of investing in luxury as a long-term bet?
I don't think so. Again, when you speak to investors, they still feel like the sector has not been, disrupted on the long-term perspective. They still view luxury goods as a really interesting, investment category going forward. And when you also, look at the, let's say, consumer perspective, so the buyers of the luxury goods, they also still, like to buy the goods because it's a long-term purchase, and even more so for jewelry, which also, of course, viewed as a very long-term purchase you can keep for a long time and even pass on to your kids or, something like that. So I think the level of appetite is still there for the long term, but right now, there is clearly a pause about buying luxury goods for the investor perspective and the buyer consumer perspective as well.
Is there any hints that any of these European luxury names are changing their production, changing their supply chains in order to adjust to this threat of tariffs?
I think it's quite limited. We have been seeing LVMH during the first Trump mandate open some facilities of production sites in the U.S. for their key brands like LV, so Louis Vuitton. They opened, I think, one manufacturing facility in Texas, so of course a few years ago, and they still, of course, have it today, which is quite useful, quite handy to today, have a weaker impact of this tariff risk. But we have not seen many other brands follow suit and do similar new openings in the U.S. on that side. It's still quite limited.
Not all luxury clothing names, of course, are created equal. Which ones have more resilience? Coming back to the first question around margins.
I think, back to the point of margin, who is more resilient? I guess you have the more defensive names like your Hermes, who of course, has higher margin, is more exposed to really high-end consumer base, which tend to, buy still more in times of macro downturn. So there is, I think, less, let's say, mass market exposure to these kind of names. Similarly, we also like a name like Richemont, which is, again, exposed to jewelry, which is a bit more these days resilient. There is a bit more appetite to buy the goods because of its long-term, purchase, I guess, view from the consumer perspective. So I'd maybe flag Hermes and Richemont a bit more these days versus the other names in the space.
Have you seen, I'm going to ask an offbeat question, speaking of LV's manufacturing and presence, have you seen the building in New York City with the the suitcases? It really brought to me, I think, a question here of where people are actually able to grow their consumer base. Is it still the popular New York, London, Paris, et cetera, or is it China, the Middle East, arguably even a Latin American consumer? Where's that growth coming from?
Yeah, I think, it's still about China for the foreseeable future. When you think about, what is coming next as the next growth driver, the brands, all still talk about China as the most important market. So the growth, I think, will come from there to start with. And then I think that, yes, the U.S. is also interesting. When you think about the, let's say, U.S. second or third tier cities, like a Denver, for instance, like Cincinnati, you also, I think, have some room to open more stores in this kind of location. So I think that, yes, these kind of markets, to me, still have some really interesting room for growth. Then you may have, let's say, next decade, countries like India, who could become bigger, but I think it won't be happening in the very short term. So
Carol,
it's still about China and the US.
Is there a euro strength headwind to luxury?
There is, yes. Of course, in my space, if you have a strong USD or like other currencies, it's much better because, of course, a lot of the revenue comes from the other currencies. So, yes, if the euro is strong, it is not great for my space. Definitely, there is a risk on that.
Okay, Carol, great analysis. Thank you very much indeed. With the deep dive, of course, on the luxury space, Carol Mancho, Head of European Luxury Goods Research at Barclays.
In the meantime, as we were speaking of that currency story, we did see some lines crossing the Bloomberg terminal. This from the ECB Centeno, saying that seeing there's a risk of undershooting the 2% as the main risk. He's making some comments here in an interview with EconoStream, which I'm told is a financial news wire. He's also saying that the weak Eurozone economy could see the euro correct versus the dollar. Some interesting comments, though, of course, as we look at a euro dollar at a 117 handle, still shy, just shy, say, of 118. A little weaker today. We'll see if that continues. Coming up on the program, how are companies preparing for a more protectionist world? The president of Marsh Specialty joins us next to discuss the supply chain story, the consumer story, and how a CEO should be thinking about that risk. Stick with us. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Out on Monday having to do with the trade deals. Could be 12, maybe 15. You know, Secretary of Commerce right here. And I guess, Howard, I would say it could be maybe as many as 15 or so. And they'll be going out on Monday, and some will go out on Tuesday and Wednesday, and it'll. And we've made deals also, so we're going to have a combination of letters, and some deals have been made.
President Trump speaking alongside U.S. Commerce Secretary Howard Lutnick in terms of what the future of those next trade deals may actually look like and where the tariff negotiations actually stand. A crucial 72 hours, as he and both Scott Bessent say. Our next guest says most companies are unaware of how convoluted their full supply chains are and where these could be affected by those sweeping U.S. tariffs. Andrew George is president of Marsh Specialty, a division of the world's largest insurance broker. And Andrew's brief also covers aviation, sustainability, construction, and energy, among other sectors. He joins us now around the table. Andrew, pleasure to have you on the program. Thank you for joining us. Just walk us through the supply chain story here. I thought post-COVID, those issues had gone away.
No. Well, this is a story we've been, or something we've been working on for a few years now. Let me give you an example. If you buy a good from China, what you might not realize is there may be 145 or more companies upstream from that. So when you think about, I buy that good and I may pay the tariff on that or the tax on that, what is quite complicated is that there may be many companies behind that in China or in other countries, and there's cross-border shift of those goods. So it's very complicated to figure out exactly what that supply chain is and therefore the impact. So many companies are saying we need to really get underneath and understand the impact of that so that we know the financial impact on us and our profitability, also our resilience.
So what's the secret sauce to that resilience?
So the secret sauce is really understanding where everything comes from and then having contingency. What we found is one of our clients said we've got a very diverse manufacturing base. We use lots of companies in lots of different areas. When they looked at it to the ultimate supplier, those ultimate suppliers were all from the same city. Now, from a tariff perspective, that may be an impact, but it could also be an impact from a extreme weather or conflict perspective. And so what companies are doing is saying we probably need a diversity countrywide, technology-wide, and we need to think about how can we be most resilient and expect the unexpected.
Andrew, I just want to reflect back on Kriti's first question and frame it slightly differently maybe, which is how much additional resilience has been built into global supply chains since COVID, and what is the gap right now?
There's been a lot of work, and we've also seen trade patterns have shifted. As people look for cost advantage, people look for resilience. There's no doubt there's more resilience, but really companies are finding every day there's gaps that they didn't expect. We built a platform, an AI platform called Centrisk, that uses a lot of data from different streams to demonstrate those gaps, and it's quite shocking the amount of gaps.
Where are the most obvious gaps right now?
There's still a concentration ultimately of supplier from a countrywide perspective.
There's an over-reliance on China still.
If I look at the energy industry, if we were in the renewable energy industry, and you were building photovoltaic, over 90% of the components for those would come from China. If you were building onshore wind, 60 to 70% of those would come from China. And so whilst there will be ramping up and building of other manufacturing around the world, there is an over-reliance in certain sectors.
Andrew, just because you're such a big player in the insurance industry, are you seeing any uptick in companies looking for revenue protection or some sort of way to hedge their tariff exposure amid all this uncertainty?
Yeah, companies are really getting underneath, first and foremost, what's right for their business. How can they thrive? How can they appeal to their investors that they have a resilient business? Part of that is through the work they will do with us to understand their supply chain. Part of it also will be ensuring that when they insure their revenue or their assets, that they're insured for the right amount. And the fact is, if your cost of production is going up because you're buying from countries where it costs more or there are tariffs, then those products cost more and therefore they'll be insured for more.
Are you necessarily seeing any bigger action in certain industries, or is there some sector that's coming to you more often for this kind of advice and guidance?
Manufacturing sectors, but we're finding when the tariff discussion was first muted, there were some that would say, let's wait and see. We're seeing far fewer of those now because they see that actually they can drive advantage from understanding their business more. And their investors are demanding that from them. And so those that have cross-border trade, those that rely heavily on manufacturing are really looking at those supply chains and how can they either decouple them or simplify them and make their business more resilient.
A little bit more sector specific here. I'm curious about your take on energy. It feels like the energy story in the States is very different in terms of the way companies operate, the way they invest, than the story you might have here in Europe. Talk to us about energy security and energy production and where the tariff story overlaps from that.
Sure. One thing that is clear is that energy demand is going to increase. With the electrification of transportation, the use of AI, data centers, the demand for energy is going to increase. Now, we see on the bill that's coming in the US, that will reduce the tax incentives for renewable energy in the US. So we're expecting a flurry of projects in the next year. Projects that were on the design block will now actually accelerate and probably be built within the next year, ahead of the deadlines set out in the bill. What we'll then see is with the tax relief going away, that makes those projects more expensive. As I mentioned earlier, many of the component parts for renewable projects are from China, and so if you layer onto that increased tariffs, it will make those projects even less likely to happen within the next decade. So what we're seeing is we've got two countries here, America seemingly backing a fossil-based natural gas way to meet demand, and China backing a more renewable-based demand. One of the things we've seen, if you look at 2023, the US, and these numbers are relatively similar, the US exported 10 times more fossil-based energy product than renewable. China exported 30 times more renewable-based export versus fossil fuel. So it seems that there's a divergent path for the next period at least. What I would say is energy systems generally are long-term investments, 10, 20, 30-year investments. So oftentimes don't just move within a period of one government. So it will be interesting to see how it plays, but I expect more projects in the next year in the US.
Andrew, are you seeing more broadly, beyond energy, are you seeing your clients coming to you saying, we are going to be reshoring to the US as a result of Trump's tariffs and the incentives?
I think every company is going through their own way of looking at things. One of the things that a lot of boards are doing is pausing and thinking, okay, do we reshore, or what if there are other tariffs that happen, and what if there are other things that happen? So what we're seeing is a lot of strategy developing, and I don't think companies are doing a lot of research. I don't think many of them are rushing to make decisions. They want to see how some things play out.
Talk to us very quickly, largely, about how much of those investment plans are ultimately based on the fiscal spend. You talked to us a little bit about the One Big Beautiful Bill, but when you talk about the spending coming from Europe, Germany, Spain, Italy, the countries that are more willing to spend, how does that factor into the thinking you're having with your clients?
So we want to be there with our clients wherever they want to invest, and we want to help de-risk those investments. Capital is an important part of a project, but technology and demand, and there are other factors. So you might be able to afford to build something, but somebody's got to give you an offtake agreement. A classic example are hydrogen projects. A lot of people talk about hydrogen and how that can accelerate. The challenge is you can build a project, you might get the capital to raise it, but unless you can get an off-taker that will give you a commitment to buy that off-take for a period of time, you're probably not going to build it because you're not certain that there's going to be a market there. So it's a very complex set of equations, and not one that necessarily happens overnight, but actually needs time to play out.
Andrew, thank you very much indeed. These developments, this complexity, this is good news for your segment of the insurance industry, isn't it?
We're a very resilient company, and we're there. We're there to help our company.
Of course, there's the pitch. Okay, Andrew, great analysis. Really appreciate it. Andrew George, president of Marsh Specialty. Thank you. Now, Donald Trump has threatened, on the same topic, of course, an additional 10% levy on any country aligned with the BRICS group, calling their positions anti-American in a social media post. The latest BRICS summit kicked off over the weekend in Rio de Janeiro, with the group's countries seeking to strengthen their ties amid the US trade war. Bloomberg Originals explores the bloc's rising economic and political clout and whether it can truly unite as a counterweight.
This is a story about how the world's most powerful, richest country is slowly losing its influence.
And it's evident here.
We can see across Brazil, thousands of Ford cars almost disappear.
Meanwhile, China's BYD is becoming increasingly common. It's evidence of the growing connection between Brazil and China, the B and the C of the BRICS Plus coalition. This is a group that hopes to rival the US-led G7.
Over time, more countries started expressing interest in joining BRICS. So now there are 10 countries.
10 countries equals economic power. Look at how the original BRICS have grown compared to the G7 in terms of global GDP since 2009. It surpassed the G7 in 2019. Now add in the expanded lineup, and its share is nearly 40%.
The trajectory is clear. BRICS countries are growing faster.
This mantra,
America first,
has created an opening.
The trade war increased the solidarity between BRICS nations.
They want a multipolar world in which there are multiple centers of geopolitical influence.
But can these countries unite to become a meaningful global force?
It's very effective as a symbolic grouping, but how that evolves is probably going to depend to some degree how on all their individual economies do, how they perceive the US is moving economically and politically, and how seriously they themselves want to move on big global issues.
And subscribers can watch that documentary right now on the terminal and on Bloomberg.com, and of course on Bloomberg Originals YouTube channel tomorrow. And this, of course, all in light of President Trump's threat of 10% tariffs on BRICS nations, or at least countries affiliating themselves with BRICS nations, which I think is an important distinction, because is he going to be looking to target China, for example, after that framework agreement with an additional 10%? Is he looking at an additional 10% on India, which we know is getting closer, we hear, according to his reporting, to a deal with the US? Or is this targeting the Saudi Arabias of the world, which have become a little closer to the BRICS? Is it a warning signal to them and de-dollarization movements around the yuan? So unpicking that, I think, is going to be important for these markets, but that was another headwind.
At least it seems like they're trying to alienate China further. I mean, you can read that through this, that anyone that agrees with China on this BRICS communique, you know, he is not in agreement with on the back foot. But if you look at markets and how they've kind of digested this recent threat of 10% tariff, you are seeing a reaction in the South African rand. It's weakening over 1% this morning versus the dollar. Also, dollar India is trading weak this morning, weaker by 0.6%. So it did seem to have a little bit of reaction on those currencies.
There's a giant, not only trade narrative here, but a giant agricultural narrative as well. The #1 export out of the United States is farming at the end of the day. Farming that's heavily subsidized by the U.S. government. And by the way, that is a lot of the base that Donald Trump is speaking to. If you take away the soy, the corn, that a lot of the initial agreement between China and the U.S. that happened under his first administration, the farming deal that was never really followed through on, where do you get the alternatives? Brazil, India, a lot of these countries that are meeting on the sidelines.
And that's one trading relationship that certainly has strengthened since Trump 1.0, which is Brazil and China in terms of the soybean trade. And so China is much less reliant on those soybeans to feed its pig population on the US versus Brazil. It now has those supplies from Brazil. It's seasonal, so there is some gap there, but they have made that change.
And you mentioned the Saudi Arabia as well. There's also an oil story there because, again, one of the other major exports of the United States, oil. Where else do you get it? Iran, Saudi Arabia, etc. Lots to digest there. Coming up, we go right back to the #1 conversation this week, which is, of course, the tariff story. With tariffs back on that list of worries for the markets, Bloomberg strategist Michael Masika argues a little caution may actually be a good thing for performance. Fascinating conversation ahead. Stick with us. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talia ki kon ahma ta chuara pango ahma le pa manjang le nyai kon mama nya.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Good morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Welcome back to the opening trade. About 49 minutes, we'll call it, into today's session. Green on the screen across the board, but not by a massive margin. The DAX is your outperformer this morning, higher by 0.4%. The FTSE 100 on the bad foot, down about 1/10%. Not seeing a ton of volume or a ton of liquidity there, but Val, perhaps a lot of that just reflecting the oil drop that's getting magnified in the FTSE 100.
Well, look, if we look at the risk events for the week ahead, there really is not a lot of big economic data on the calendar. The one big thing on the calendar is the Trump tariff deadline coming on Wednesday. Today, we also have the second day of the BRICS summit in Brazil. Tomorrow, the UK is going to be hosting Macron for a state visit. And the biggest economic data of the week is Thursday, U.S. jobless claims. So I think it kind of sums up how light we are on the data calendar. Friday, we also get Canada employment data to round out the week.
Okay. Now, nations are scrambling to secure trade agreements, of course, with Washington or lobby for extra time ahead of Wednesday's deadline. President Trump says he will send out letters about tariff plans starting later today.
We're going to be very busy over the next 72 hours. President Trump's going to be sending letters to some of our trading partners saying that if you don't move things along, then on August 1st, you will boomerang back to your April 2nd tariff level. So I think we're going to see a lot of deals very quickly.
US Treasury Secretary Scott Bessent, of course, over the weekend commenting on the timeframes and the moves to try and shore up some of these potential deals. For more on the market reaction to this, let's bring in Bloomberg's Michael Masika. Michael, you've been writing about the fact that the move's a little lower on European stocks last week, so the end of the week lower, and that's no bad thing necessarily for these markets because these are markets now slightly more in balance, is the argument that you and the team are making.
Yes, it's a strange thing. You know, we had like a big increase in positioning on Europe, big expectation building in. Everyone kind of forgot about the tariffs. If you look at how investors were positioned ahead of today, it's strange. Like it's like this tariff deadline is a non-event. It's treated like a non-event. So either everyone has been hedging a lot and everyone is ready on their portfolios, or everyone is still underweight, which looks like it's the case. Like positioning is a bit like neutral at the minute, generally speaking. So it's like a wait-and-see situation. So we'll see the reaction. I mean, last time it was exactly the same on April 2nd, and we all know what happened. So we'll see. A bit of caution is not bad thing, indeed.
Is it caution or is it complacency? Is there a lazy trade in this market?
I wouldn't say it's complacency. There's a bit of complacency on the actual outcome, that we can say. But at the same time, if the positioning overall is neutral, if investors have been just chasing gains higher and are still not overweight equity overall, which is the case in the US definitely, then it's not really complacent. It's more like it's still caution, yeah.
I thought maybe this morning equity markets would be higher on this new deadline of August 1st. I thought maybe we'd see a drop in things like euro-dollar 1 week implied volatility. Have we seen any action in terms of options pricing around European equities around the risk event of Wednesday? Or are we just not pricing that in at all?
No, we haven't been pricing anything. It's like I said, non-event at the minute. So either because people are really well positioned already for this, or because, and I think that's what a lot of investors are thinking, it's like nothing is going to happen except either an extension or we'll get some kind of deals with partial deal and then we discuss some other specific points. And that's what everything's thinking at the moment. No one wants to believe in a full-blown trade war because of what happened over the past few months. It tells investors, okay, no one wants a full-blown trade war, so let's see what happens on Wednesday.
Michael, is the big, beautiful bill that was passed by President Trump on Friday, signed into law, is that a future catalyst or is that fully priced in for these markets?
I think a lot of it is priced in, because if you see what happened on the Max 7, what happened on the NASDAQ, how a lot of investors have been buying tech stocks like massively over the past few weeks, you can tell that fiscal spend is now getting properly priced in the markets. There's like, you know, we came into this year thinking the US is not the right place to be because of, like, Europe had a lot of fiscal spend, the US didn't, and then the Fed had higher rate than Europe. Now things are kind of switching. It's like investors are going back into tech because the US is going to spend. They don't care about the deficit. The Fed is looking like it's going to have opportunity to cut rates as well. And so,
but is that a NASDAQ story or is that a Russell 2000 story?
Well, at the moment, people just buy the tech. It will become a Russell 2000 story because obviously small caps will be the beneficiaries of a fiscal spend. But at the moment, this is not what's happening.
Well, it feels like the stock market and the currency market are dancing to two very different tunes. Is one affecting the other? Is dollar weakness incentivizing flows into the equity market?
So since the start of the year, we have seen a lot of that. Dollar weakness with euro strength was a very big positive for Europe. We had like a switch of assets from the US to Europe, but it kind of stalled at the minute. And now what we're seeing is it's very focused on the currency. So the dollar is still expected to go into bear markets this year for a lot of reasons, including the fiscal spending. But it seems the transition between the dollar weakness and what's happening to the equity market has kind of slowed down a little bit. So maybe we'll have that on emerging markets, especially because they're like the biggest beneficiary of the dollar weakness.
Michael, regarding these letters that the Trump administration is going to be sending out to trading partners this week, do you think there's a consensus within the market of the number that the EU is getting?
Well,
like, would 20 be a shock? Would 30 be a shock? What's a shock number?
I think anything above 10 is a shock number, because at the end of the day, that's what people have been expecting. Like, you know, we'll have 10% tariff and that's it. It's okay. People will live with it. But if you go back to what we had in April, everything will be a shock.
Yeah, it does sound like markets are complacent given Trump's latest threat on the EU was 50%. Well, yeah. They're expecting 10.
And there's the autos, sectoral tariffs, there's the pharma tariffs, and the assumption is in these markets that we're going to get a baseline 10%. That does feel like that would be a very positive outcome.
Yes, it would be. I mean, if you look at, like, especially for pharma, you look at the deal with Switzerland, pharma is likely to be included in that. If we have the same in Europe, well, you know, it's a positive for all the pharmaceuticals in Europe. I mean, it's like anything above 10 will be like a bit stretched. If we get 50, I mean, yeah, well, that's definitely not going to be taken positively by the market for sure.
It's a fascinating one. I think we had guests on the show last week saying that 10% is priced in, 20 is absolutely not. We'll see how that all shakes out. Bloomberg's Michael Masika walking us through the dynamics of these markets. We thank you so much. That does it for the opening trade. The Pulse is up next. Francine is speaking to Portugal's finance minister as the clock ticks, as we were just saying, for the EU to seal a trade deal with Washington. Throughout the morning, we've also heard from the Portuguese central bank governor as well, also talking about that risk, saying that there might be a correction when it comes to the euro. It'd be interesting to see what the Portuguese finance minister has to say on that, and maybe their defense plans, their spending ability. There's a lot to digest there. That conversation on the Pulse up next. As I said, that does it for the opening trade. These markets, seeing some green on the screen, light volume, light liquidity across the board, but your DAX is the outperformer this morning, higher by 0.3%. Stick with us. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. President Trump threatens an extra 10% tariff on countries aligning themselves with the BRIC group. Well, says tariff letters and trade deals will be announced later today. Now, China will impose some reciprocal curbs on medical device imports for companies based in the EU, fueling further tensions between Beijing and Brussels. Plus, President Trump slams Elon Musk's plan for a rival political party, sparking concern among some investors that Tesla could face more blowback. Now, happy Monday, everyone. There's a lot going on, especially on the trade front, so we have full team coverage. Ahead of that, let's also check on what the markets are telling us and warning us of. Now, stocks seem to be a little bit retreating at the start of this potentially volatile week again as the U.S. trading partners, I imagine, right now are rushing to finalize trade deals with the Trump administration ahead of a July 9th tariff deadline. I'm looking at euro-dollar 117.46. Now, trade tensions again back in view as the tariff deadline approaches. But then a couple of other things that we're watching out for is, for example, oil. Metals in general fell. The yuan weakened after Donald Trump saying that those aligning with the BRICS group of nations will face an additional 10% levy. And then Europe pretty much flat. You see the CAC 40, the FTSE, and the MIB 30 actually flat. And then the DAX getting some 0.3%. Onto corporate and Tesla shares coming under increasing pressure as the feud between President Trump and Elon Musk intensifies, while Trump has blasted Musk's bid to start a new political party. Tesla down some 7.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Our nation's scrambling to secure trade agreements with Washington or lobby for extra time ahead of Wednesday's deadline. President Trump says he will send out letters about tariff plans starting later today.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. The tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
Well, we're now joined by Ozan Taman. He is Vice Chair of Global Macro at Deutsche Bank, Rosalind Matheson, our EMEA News Director, and Brendan Murray, our Trade Czar. So thank you all for joining us. Brendan, you're probably the busiest one here because it's trying to now understand why the letters are delayed. I mean, it's all a question of timing, and what other countries are doing now to either, delay the imposition of tariffs or negotiate.
Yeah, it sounds like the administration is trying to buy itself another 3 weeks. We heard Treasury Secretary Bessent on the Sunday shows yesterday say there's been some congestion here at the finish line. And so this is what happens when you're trying to negotiate a couple of dozen trade deals in 3 months. They start to pile up and they get complicated at the end. And therefore, the Trump administration is saying that deadline that was initially July 9th, we'll give it a little bit of flexibility till August 1. Now, we also heard him say that there are going to be some big deals announced as well. We could see, the main ones that we've reported on are, it looks like the European Union. There might be some sort of framework that comes together. India, we've been talking about for weeks, that happening. Vietnam, the president announced it last week, although Vietnam didn't confirm it. So some of these deals could come together between now and Wednesday. But as we heard Secretary Lutnick say, they need some more time to set the rates for the countries that don't have deals and maybe see if that'll bring them to the table.
But I mean, so the BRICS group is also getting slammed a little bit more. Again, is that a negotiating tactic, or is it basically countries that align themselves with BRICS?
Yeah, it sounds like another in a series of complaints that the president has with the BRICS countries and what the BRICS are organizing themselves to do. He's railed against their efforts to create some sort of alternative for the dollar in the global trading system. So 10% is not a big tariff based on all of the ones that we've seen from President Trump. So I think it's more of a way to annoy the BRICS as they meet for their summit.
So, Ozan, how is that all playing out in the markets? Because, again, there's quite a lot of tension, but a lot of the equities were at record highs. So they're pulling back a little bit, I guess, in a wait and see.
Incredible comeback from equities, as you said, at all-time high levels. For reasons Brendan put nicely, this timeout taken until August 1, equities are a bit in red, but calm. Because both Bessent last night in the shows, Lutnick right next to the president, is emphasizing that we may still have 3 more weeks of negotiations. Some letters will fly out, so it's very understandable that people are taking some chips off the table. It's been an incredible run. But I still think this trade tension in itself, trade tension 2, will not be enough to derail us from a nice summer of carry.
Brendan, at the first time around, there was a little bit of, I guess, bravado, and certainly there was some kind of chart with an equation that didn't make that much sense. Are things a little bit serious now?
Yeah, it would seem so. I would also offer that the 3 weeks extension might give the markets a bit of a breather, but it's also extending the uncertainty. All of these different countries that trade with the U.S., what is their tariff rate going to be? Remember, the president says these tariffs are being put on the countries, but they're actually being put on the American importers, bringing goods from those countries in. So I think, this is going to extend through earnings weeks in the weeks ahead. And so I think we're going to see uncertainty, still the cloud lingering over the global economy.
All right, Brendan, thank you so much. Brendan Murray has to go to radio. Roz, when you look at, the BRICS leaders, I mean, this is China and India. How much of a retaliation could we see from the Chinese side?
Well, it's interesting, as Brendan was saying, this seems to be more about Trump just trying to needle BRICS. I mean, he was always a bit dismissive of BRICS, and then as BRICS expanded and the membership has gotten quite big, if you look at BRICS now, it's a significant part of the global economy of output and trade. He's become more and more critical of it, and they're obviously been meeting this weekend in Brazil, so he's sending them a message. If you come too much together as a group and you see yourself as an alternate power entity to the US or some of the Western-led institutions, then I will come and challenge you. But they're not really commenting from BRICS on this today. Most countries don't want to go anywhere near it, and possibly just seeing it as a trial balloon from Donald Trump. But what it does show again is that he's watching very carefully as some of these power blocks shift around the world, and we do see powers start to gather also in what's known as the Global South.
Yeah, and also, I mean, what I'm surprised about is that non-farm payrolls were actually fine. I mean, it's not really all of this uncertainty is not translating into equities or really the U.S. economy for now.
France, in team stagflation has been losing for a while. So that's one emphasis that I want to put. Inflation has been coming on the tame side. People keep saying next inflation will be hot, maybe, but as Secretary Bessent is saying, maybe team transitory should come to play in that again. And non-farm payrolls.
How is that possible?
Because people keep delaying the wounds of that tariffs onto the next one. So maybe, yes, next one will hurt, or the August number will hurt. But then after that, consumption may come lower, and September and October prints can be more tame. So I do have some sympathy with the arguments that Waller and Bowman are making beyond the politics, actually. And on the stagflation, on the growth side, like you said, last two non-farm payrolls again, at least on the headline side, pretty healthy. That's why retail kept on buying the dips, and so far they had beaten the professionals on the equity side. On trade, two things to very quickly mention. One country, very important country, Brandon didn't mention for a reason, Japan. There, very surprisingly, the deal negotiations are not going so well, and long yen is a crowded trade, so watch out if there are no great developments. And on the ROEs and BRICS, two countries that are dear to our emerging markets, not just China, but Brazil and India. Brazil also very popular trade. Long India is popular. Emerging markets had a great run. So all of a sudden, negotiation tactics or not, if you have a tough July 9, uncertainty over those three, that can give you another dip to buy.
Yeah, I mean, I know some, market analysts think there's just been too much relaxation. Japan was came out of the blue last Monday because of rice prices. Is there, when you look at the Trump administration, I mean, is there a clear pattern of what they want to do? Or again, I can't figure out how much of it is negotiating tactic or, the president being mad at this group or that group, and how much of it is actually trying to negotiate to get money in the coffers.
Well, it does seem to change on a daily basis, and it's very personality driven. So, but equally, again, the pattern is push these countries towards a deal, declare a deal, because above all, he needs to declare the wins. He needs to stack up a bunch of paperwork and say to the American people, when you elected me, I promised you I'd do this, and look at all these deals. Do the deals have to be terrific? Do they have to be detailed? No, they're all framework understandings more than full-throated trade deals. And again, very personality driven. But what is clear is that by nominating August 1, this is a chance for countries to negotiate. Even if they get a letter and they get told their rate, they can still negotiate because the US will be willing to do so. I mean, Japan is an interesting case in point, because as we're talking about, each country does matter, because it matters what they produce, what they sell, what the impact is on the US companies, on the US consumer, and what they're paying in terms of the economic feed through to the US. So Vietnam is important, even though it's a smaller economy for that reason. Japan is significant for that reason. The EU, I mean, it's not just really big economies that are going to matter here potentially for the US consumer, it's smaller ones too. So it's passing all of those individual deals and saying, collectively, what's the impact here on the US economy?
We also have a viewer question, and then we need to talk about Tesla and Elon Musk. But, Ozan, how do economists weigh the animal spirits of Trump's deregulation agenda? Is this a heavyweight behind U.S. equities? I mean, this was meant to be the big trade,
I was going to say, we read each other's minds, that it was supposed to be the big lifter. Then just 6 weeks ago, when we were in Qatar Economic Forum together, remember the long end sell-off? All of a sudden, the narrative changed. People got very worried about even a trust moment for the U.S. I think now that narrative is coming back. He passed it on time. It's going to give a lift to equities, but come September, there will be a big match on the long end. Those who are very pessimistic, believing that even more cuts will create a big sell-off on the long end, versus those who side with, I guess, Secretary Bessent and expecting a more of a flattening. So big battle to come on September. Also, quickly, we talked about the US side of the story, but European, Deutsche Bank, there's a big story on the German side as well. So not only this 1 trillion, 1.1 trillion, but the fact that MERS is able to show that it can be front-loaded. 500 billion on defense by 29, 300 billion on infrastructure. My chief German economist Winkler estimates that it will be 20% of GDP in Germany. Those are big numbers. So that in itself gives a big boost to European story, e-stocks and euro.
Okay, we also need to talk about Elon Musk. Now, Tesla shares slumping pre-market as a feud between Donald Trump and Elon Musk intensifies. Now, the U.S. president has criticized the Tesla chief executive's plans to start a new political party. Musk announced on Saturday that he was forming the America Party a day after Donald Trump signed the tax and spending bill that he had denounced. Now, the U.S. president signaled that he's not taking the announcement seriously.
It's always been a two-party system, and I think starting a third party just adds to confusion. it really seems to have been developed for two parties. Third parties have never worked. So he can have fun with it, but I think it's ridiculous.
Well, let's bring in Craig Trudell, our global autos editor. Craig, I mean, there was also talk about deportation and things like that. How has Musk's, latest been received by traders, and how are investors really worried about risks to Tesla?
Well, you only have to go back just a few months, right, when Tesla last had an earnings call, and, the sort of opening remarks from Musk was, look, I understand there's been blowback about my involvement in politics and my role that I've been playing in the White House. I'm going to be stepping back from that and devoting a lot more of my time to Tesla. That is not what investors are getting, and that's why you're seeing this really, sort of pretty dramatic move lower for the shares every time, he goes right back and touches that stove. This is yet another, instance of him sort of going back on what he told investors and what he was assuring everybody, only a matter of months ago, that he got it, he understood it, and, knew that he needed to get back to work at the company, which, by the way, continues to struggle in pretty dramatic fashion and did not have the second quarter that I think even he was hoping for.
But, Greg, the risk is what, he's not focused on Tesla, or that actually he gets slammed by President Trump?
I think it's both, right? I mean, I think the fact that he is very clearly not sort of holding to his word of getting back to work. I think that it only adds to uncertainty about his sort of role at the company going forward. We should be reminded that the board has disclosed that it's looking at compensation for him. Does this sort of complicate efforts to put together a compensation package and go to shareholders and say, we should pay this guy, a whole lot of money after he's, gone back on his word to sort of devote more of his time. And also, I think there's real risks for, the administration to target the company. I think, for the moment, we've only heard a lot of conjecture in that regard, and it would be maybe surprising to see, the president go after somebody who was such a staunch ally for so long. But, he is at least verbalizing this possibility that he could go after him and his companies.
And Ross, what do you make of all of this? Is there a chance for a third party given the turmoil that we're seeing at the moment?
Well, historically, not really. I mean, third parties come and go in the US, but failed to get a lot of traction. You do get independents from time to time in the House and the Senate, but you don't get that kind of collective movement because the political structure just doesn't really support it. You need to have an awful lot of money behind you for a start. And as a political party, obviously, Elon Musk would have that, but then you've got to get the mobilization. So whether he could is a question, and whether he will. I mean, interestingly, he just can't seem to stop himself. He does have, for right or wrong, a sense of grievance here. He feels, A, he holds grudges, but B, he'll say, I stepped away from my businesses. You asked me to come and do this. I feel I delivered. I neglected my businesses. In the meantime, I did all of this for months, and you've wiped it away with this big, beautiful bill that you've enacted. And he feels a very strong sense of grievance about that. So he keeps coming back and pressing on the bruise with it and threatening this political party, whether he does it or not. It's clear that his relationship with Donald Trump has completely changed.
I mean, does a big, beautiful bill, Ozan, actually change policies? Again, does it impact inflation? I mean, it's so big, actually, and large, that it touches a whole swathe of things.
I think it will bring the long end back. Come September, come October, we will test it. Bond vigilantes, they will try their hand again. But on terms of inflation, as I said, testing times, yes. Big trust moment, stagflation camp winning, I still don't see. After the last NFP, we shut the door on the July cut. But if anything, there is still a chance, not only that Fed cuts 25 in September, but if we get some slowdown, people push them to go for another 50, just like last year.
Okay, thank you all for joining us. Ozan Tarman, their Vice Chair of Global Macro at Deutsche Bank, Rosalind Matheson, our EMEA News Director, and Craig Trudell, our car czar. Coming up, we're in conversation with Portugal's Finance Minister as the clock ticks for the EU to seal a trade deal with Washington. That interview is next, and this is Bloomberg.
up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Well, work by European Union officials continued over the weekend to try and secure a trade deal with the U.S. as the deadline nears. Tariff discussions will be high on the agenda as Euro area finance ministers meet in Brussels today. Well, ministers will also vote for a new president of the Eurogroup, which chairs the monthly meeting. Well, I'm delighted to be joined by Portugal's finance minister, Joaquim Miranda Sarmento. Minister, thank you so much for joining us. What's your latest view on trade negotiations with the U.S.? What do you think the end results will be?
Well, good morning. Thank you very much for your invitation. The deadline for those negotiations is next Wednesday. We expect on the meetings today of the Eurogroup and tomorrow of ECOFIN to have already some update of what the Commission was able to negotiate with the U.S. administration. As we have always said, tariffs hurt economic growth. Tariffs are a problem in terms of the efficient allocation of resources. Tariffs will reduce economic growth both on U.S. and Europe, and they will mainly hurt consumers and particularly those with low income. So we do expect that at the end it's possible to have an agreement with very low tariffs, an agreement that could be perceived as beneficial for both parts and that could continue to allow us to trade and to increase value for our citizens.
Minister, do you think that the EU would be right to retaliate if the terms of the deal were not favorable?
Well, if the terms of the deal are not favorable for the EU, then there is no agreement. And in that case, obviously, the European Union will have the discretionary possibility of making decisions. I do believe that just like happened in 2016-17, when the U.S. administration, also led by President Trump at the time, raised tariffs, the European Union was very selective on the tariffs that have increased concerning the U.S. And I think that experience and the lessons that we learned from that experience should be replicated now. If an agreement is not reached, and I still believe that an agreement is possible and desirable, and I still believe that even if on Wednesday is not possible, there will be most likely a new deadline for an agreement. But if at the end of the day an agreement becomes not possible, Europe should not retaliate on a full scale, but should be very selective in order to protect the European economy and to protect the European consumers and citizens. That's our first and foremost mission.
Minister, you have a lot of decisions to make in the next couple of weeks and months. Who will you, Portugal, actually back as a new and the next Eurogroup chief?
Well, the Portuguese government is represented by a coalition that is in the European Popular Party. So we will support the current president, Pascal Donnet from Ireland, who is also a member of the EPP. The three candidates are all very good candidates. My three colleagues are three excellent finance ministers with a lot of experience and technical skills, but we believe that the current president should continue for an additional term.
Yeah. And have you decided, has the government decided who it will name for Bank of Portugal governor? Will you reappoint the current one?
That's something that we're still evaluated, and we'll make a decision in the short term.
Minister, I also wanted to ask you about how big of a stake you want to sell in TAP.
We will sell in this first moment less than 50% of the capital, and we will advance on the selling process in the coming weeks, trying to find an international partner that could help us to develop the company, increase the routes, increase the number of planes, increasing investment in the company, and then obviously recovering some of the money that the taxpayers put on the company 4 years ago.
So do you have a calendar of when you'll announce the rules of the sales? And actually, have you spoken to potential bidders yet?
Well, in the last year, we had meetings with several potential candidates, large aircraft lines that are very interested in TAP, and we will announce the process and the start of the process in the coming weeks.
Minister, do you have a valuation in mind that you would be considering for TAP?
Well, we do have, and when we announced the process, when we announced the conditions, the timeline, the conditions to be included or excluded from the process, we'll also make public that valuation.
Okay, so Minister, I hope to get you back on Bloomberg TV then, but very quickly, what kind of foreign investment are you expecting in Portugal this year?
Well, we had several agreements. We had Lufthansa Technik, we have Kalb, which is a Chinese battery factory for electrical vehicles. We have the new electrical vehicle of Volkswagen. We have several companies investing in IT, research, and shared service centers. We continue to focus on bringing to Portugal foreign direct investment, mainly on technological areas, in industry where technology is also critical. So we are continuing to work in attracting large industrial projects that can have spillover effects on a small economy like Portugal.
Minister, as always, really thank you for your time today. Joaquim Miranda Sarmento there, Portugal's finance minister. Coming up, OPEC Plus surprises markets with a bigger than expected crude production hike. We'll talk oil next, and this is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage. The numbers will be quite substantial. Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump threatens an extra 10% tariff on countries aligning themselves with the BRICS group and says tariff letters and trade deals will be announced later today. China will impose some reciprocal curbs on medical device imports for companies based in the EU, fueling further tensions between Beijing and Brussels. Plus, Tesla slumps in pre-market trading as President Trump slams Elon Musk's plan for a rival political party. So, on to one of our top stories on oil falling this morning after OPEC Plus agreed to boost production by more than 500,000 barrels per day in August. Now, the bigger-than-expected hike has surprised markets and raised concerns of a glut, just as U.S. tariffs spark worries about the demand outlook. Now, for more, we're joined by Bloomberg's Horizon anchor, Jumana Bersecci. So, Jumana, welcome to London. Why is there another upward surprise from OPEC?
Yeah, well, I mean, I should say, Francine, that it took them 10 minutes to make this decision. So pretty unanimous. It was quick. They surprised the market once again with a larger-than-expected output hike, bringing back 548,000 barrels to the market, more than the 400,000 odd that they've been bringing back the last couple of months. And indeed, it is an upward surprise. But then you look at the reaction in Brent this morning, and it hasn't been huge, and namely because OPEC Plus seemed to believe, or at least the voluntary cutters, the G8 as they're known, seem to believe that the market can absorb it. They speak about steady global economic outlook. They talk about healthy market fundamentals and low inventories. So it seems to be the case that they're taking advantage of this strong seasonal demand. Right now it's summertime, it's peak refining season. There's lots of use, electricity demand in Gulf countries, obviously air conditioning units for transport fuel in the West. At the end of the summer, some of those seasonals are going to start to subside, and that's when you could probably start to see this inventory build up once again. So looking ahead, you want to watch out for further non-OPEC supply. Of course, that has been a major driver of the market, not just out of OPEC, but out of the likes of the US, Guyana, Brazil, as we've been talking about. But then also whether you're actually going to see an impact on demand based on some of the uncertainties around the global economic outlook, and whether that's also going to start to build up inventory. So the likes of Goldman Sachs, JP Morgan do actually see Brent returning back to around $60 by the end of this year, namely because they see supply growth massively outpacing demand growth in the coming months by a multiple of 3 to 4 in some cases.
Jumana, thank you so much. Jumana Bersecci there with a terrific update on what we heard in the last couple of days. Now we're joined by Nadia Martin-Wiegand, Director of Svelent Capital. Nadia, thank you for joining us. I mean, the concern is, I guess, is there going to be an oversupply or not? For the moment, OPEC has been proven right time and time again.
And as we see with Saudi Arabia, they've raised the prices.
by $1 a barrel for the next month as they increase supply themselves, probably forecast by at least 200,000 barrels per day. What we view at Stellan Capital that they've been doing is they've been putting in a bit more at a time and seeing how the market handles it. We didn't physically see the oil until June when we had the 12-day war develop, and that's when we saw an extra 100,000 barrels per day from Iran. We saw an extra 450,000 barrels per day from Saudi Arabia. And yet the market absorbed it. We're in steep backwardation and refinery margins are great. So far the strategy has been working.
I mean, what kind of impact does that have? And we have a great viewer question actually on this. What kind of, does this mean that there's a reaction from frackers? So this viewer is writing in saying, is this putting OPEC on alert for U.S. frackers to increase output at a cheaper cost?
Well, it is putting pressure on them, but it's not the kind of strategy that we saw during COVID where they needed to break shale. Yeah. And the 12-day war changed things for the frackers because they could hedge not only next year's volumes, but also the fourth quarter this year. So where they were starting to feel this pressure at $55 to $65 a barrel, helped by high natural gas prices, but those have come off at Henry Hub in the U.S. Now they're more hedged. It doesn't affect Exxon that has huge efficiency gains, but some of the smaller independent producers, now they are more hedged. So it's not going to take 2 or 3 weeks for Saudi Arabia and OPEC to break shale. It's going to be more gradual. And when we look at our forecast for U.S. supply growth, last year we were thinking 400,000 barrels per day year on year was possible. Then we saw this pressure, we saw flattening out, but now we might actually see 100, 150,000 barrels per day year on year growth by year end, even though it's been flat year to date.
Yeah, but now, I mean, this is a massive bet also on the global economy that stays strong and a U.S. economy that stays strong despite everything that we're seeing with trade.
Absolutely. And I mean, this decision came ahead of the trade announcements. We know the big, beautiful bill is passed. So that, in our view, is inflationary and supportive. But at the same time, a weaker U.S. dollar is great for emerging markets if that is what ends up being the result of this. So we can see that demand. I mean, right now, the largest growing economy in terms of oil demand is India. And so a weaker dollar is helpful for them. China's own demand isn't growing, but they're still importing crude. They're stock building, but it's strategic. So it's not a problem for the overall balance because globally, when we look at the OECD inventories, we're at a very low level. And so even if we're building at least 1.5 million barrels per day, which is our forecast from September onwards, a poor trade outcome, we're looking at 3 million barrels per day. But it's not an acute disaster until really, say, Q1 next year. The issue is that the market, once it clears out this tightness, right now we have physical tightness in the market, then it starts looking ahead. And that can be a quarter ahead, and that's when we can see that downward pressure that Goldman Sachs and Morgan Stanley are talking about.
But Nadia, it also means that actually they're taking a bet that, I guess Iran quietens down from what we saw in the last couple of weeks.
Well, Iran actually boosted production. They boosted exports by 100,000 barrels per day. Trump said, oh, China, you can buy Iranian crude. But when you look at the tanker companies, the Western tanker companies are not willing to touch Iranian crude right now. Iranian crude is still using this dark shadow fleet like the Russians. And this is a big question in OPEC Plus because the Russians are supposed to increase production 100 to 160,000 barrels per day if you look at the last 2 months, and they haven't really been doing that. Will they be able to do this in a decrepit, dangerous, dark fleet that can have accidents? And at a time when it especially delivers to these independent refiners in China that Beijing wants to marginalize.
But did you see, the Trump comments were taken with a lot of skepticism by others because, we knew that it was happening. But is this a change in U.S. policy, or did he just misspeak?
Well, maybe he's front-running policy. As of right now, there are no changes in terms of the rules. And the sanctioned ships continue to be sanctions. The Treasury has not changed anything. But maybe there's an openness. But as we know, Trump likes to play both sides, right? He'll play hardball, and then we have Netanyahu coming today. Let's see what he thinks after that. But he's showing a willingness to play on both sides. And of course, Iran turned out to be much weaker than we thought. And so they desperately need the money in selling crude. Russia desperately needs the money in selling crude. But on the other hand, it's an opportunity to squeeze both of those countries. And of course, when we think about BRICS,
Yeah, and given everything that's happening with tariffs, how difficult is it to predict the price of oil? Is it going to be range-bound or volatile?
Well, right now it is range-bound. If we're above $65 a barrel Brent, we don't have an algorithmic trading signal to sell. And that was the big difference when we entered this 12-day war, is that the market was net short. Then it started to turn long. Not everyone was max long, and now we're in a balanced market. So that's where the range is comfortable right now.
What kind of level does Donald Trump want? And is this also a helping hand towards U.S. policy?
Well, he always wants it a bit lower. Right now, we see 1% year-on-year growth in demand for gasoline because the price is about 7% cheaper at the pump. 10%, 50 would be even better. But the problem is, if he goes down $10, that oil industry in the U.S. will suffer more. And he wants drill, baby, drill. And also on the gas side, because there's a lot of associated gas. LPG is a huge part. You know, that's half of the shale growth, if not more. And when we look at these trade barriers, you know, China's granted a reprieve on ethane, but not yet on propane, that to keep that tariff-free like they did in Trump 1.0. And that's a very important part of that growth chain, because we need that to make plastics to send Barbies to America.
There you go. I mean, extremely crucial and important. Nadia, I mean, services companies, you believe, are prioritizing offshore growth. So again, how does that change dynamics in the U.S.?
So what we saw when the shale boom happened and then the collapse in 2014, 2015, 2016, is that the service operators, when we had that uptick, they didn't have the capacity to boom. What we see now with oil field service operators, they're prioritizing offshore, they're prioritizing gas, they're not prioritizing shale. So what that means to us is their equipment can get run down already at these kinds of prices. So if there is an upturn, then they can't boost that much, which means that this OPEC Saudi policy of slowly adding more oil into the market, putting pressure on shale, means that we might not see these 500,000 barrels per day, 1 million barrels per day year growth year on year in the U.S. ever again. It might be 150,000 barrels per day. And that's how they slowly gain market share without breaking the oil price and actually forcing bankruptcies in companies.
So interesting. Thank you so much for the terrific update. Nadia Martin-Wigan there, director of Sveland Capital. Now, coming up, Donald Trump says a ceasefire in Gaza is close. We'll look ahead to his talks with the Israeli Prime Minister in Washington later today. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Welcome back, everyone. Now, stocks are falling as the deadline, of course, of the tariffs from Donald Trump is approaching. Overall, stocks retreating at the start of the week. U.S. trading partners rushing to finalize trade deals with the Trump administration ahead of a July 9th tariff deadline. Now, the couple of things that we're watching out for, trade tensions are back in view. Again, Donald Trump pledging to start issuing unilateral rates to dozens of countries in the coming days, causing uncertainty in the markets. Now, when the Labour Party came to power in the UK a year ago, business leaders decided to give Keir Starmer and Rachel Reeves a chance to forge a new and stronger relationship. But the past 12 months have seen tax hikes on employers, market jitters, and recent talk that Britain's biggest listed company, AstraZeneca, might defect from the London Stock Exchange. So, how is Labour's relationship with business now? Well, let's bring in our trade reporter, Jennifer Creary. Jennifer, thank you so much for joining us. So how much have things actually soured in the past 12 months?
Yeah, so when the Labour government came to power, there was this real sense of optimism among business leaders after, 14 years of Conservative rule and, of course, the chaos of Brexit. 12 months on, a lot of that optimism has faded. And one of the key turning points really was the budget last year, where the Chancellor hiked up, employment taxes and hiked up the minimum wage, and that's really heaped costs onto business. Now you see companies, announcing job cuts. There's this knock-on inflationary effect with food prices rising, and of course there's that report that you mentioned of the head of AstraZeneca looking to move its primary listing to the US, citing what they say is red tape over the UK's regulatory regime on medicines. So it really was that budget that blindsided a lot of business leaders who thought that they had a good relationship with the government, and one that the party was so kind of desperate to cultivate ahead of the election.
So Jennifer, what are the biggest concerns that business leaders have now?
Well, I mean, there are a couple. So, of course, there's the labour market. So there's the cost of employment with that higher minimum wage and payroll tax, and that's going to have a knock-on effect on the country's employment rate. There's, of course, that regulatory red tape that we mentioned, and that's had an impact on investment and delays to investment. There's the departure of non-doms, so these kind of wealthy foreign residents leaving the UK after the removal of that tax break regime. And, of course, there's Labour's clampdown on visas, which was seen to kind of appeal to more kind of right-wing voters, but of course it's making it harder for a lot of businesses to hire talent. So one of the sectors that's been particularly impacted by this is the care sector. So one of the main concerns that's kind of top of mind for a lot of business leaders is whether Labour will raise taxes again in the upcoming budget. But above all, businesses want to feel like they're being listened to rather than kind of cast aside and ignored, and the upcoming budget will be a real test of that.
Jennifer, thank you so much for the terrific briefing. Jennifer Creary, there, our UK retail reporter. Now, the U.S. president has threatened an additional 10% tariffs on countries aligning themselves with what he described as the anti-American policies of BRICS. Donald Trump has previously threatened 100% tariffs on the BRICS nations if they stopped using the dollar for bilateral trade. While Brazil currently hosting a two-day BRICS summit with the Russian President Vladimir Putin attending remotely and the Chinese president sending his premier Li Qiang. So let's get more from Alan Wong, Bloomberg's China economy and government editor. So Alan, Trump's post did not say which BRICS policies is anti-American. What might have triggered his anger last night?
Yeah, exactly. What a lovely Sunday night surprise from Trump. We don't know really which of the BRICS policy, if there is such a thing as a BRICS policy to begin with, that Trump was referring to that might have triggered him. What we know that the leaders of BRICS countries, they did issue a statement at the end of the summit, and the statement is 31 pages long with many, many paragraphs. And I think we could just make some educated guesses here. The statement mentions their opposition to unilateral tariffs. It also mentioned more political element positions that those countries endorse, such as condemnation of Israel strikes of Iran, and as well as the U.S. strikes on Iran, which obviously is a BRICS country. And there's also mentions of the support for calls for Israel to withdraw its troops from Gaza. So all those things, any of those things could have triggered Trump. And now Trump is not just saying that BRICS countries that support those policies might face 10% of additional tariffs. It's saying that any country that align themselves with those policies could get those tariffs. So it's really anyone's guess of what exactly he means, and hopefully he will elaborate on it, and so that we know who is in for more tariffs.
Alan, the trade dispute between the EU and China is definitely heating up. What's the latest spat about, and what does it mean for their upcoming summit?
Yeah, more news over the weekend with China retaliating an earlier EU measure that sought to cut off Chinese companies from bidding on public contracts in the bloc. And China's measure was a countermeasure to that, and it's also preventing EU companies from bidding on public procurement projects in China. So it's a minor sideshow to what is going to be a bigger meeting between EU and Chinese leaders later this month in mid-July, when this might touch on issues such as tariffs on Chinese EVs and also China's support for Russia after its invasion of Ukraine, which are matters that the EU cares a lot about. We're getting some mixed signals about just how ties are developing with with EU and China exchanging these trade measures, but at the same time, China says it wants to close the ties with the EU and is ready to work with the EU if it chooses to. So ahead of the summit, we're seeing some early reports of the EU and China not being able to agree on some joint statement on matters such as climate action. So that's just one more sign that things are really in the flux right now.
Thank you so much, Alan Wong, there, Bloomberg's China Economy and Government editor. Now, President Trump says the U.S. will discuss a TikTok agreement with China on Monday and Tuesday, and that Washington and Beijing, quote, pretty much have the deal. Tech publication The Information has also reported that TikTok is building a new version of its app for U.S. users ahead of a planned sale to a group of investors. Now, the company reportedly plans to launch the app in the U.S. stores in September. And rescuers in Texas are still searching for at least 10 children and a camp counselor who are missing after catastrophic flash flooding. At least 70 people have died, including many children attending youth camps over the holiday weekend. Officials are struggling to explain whether they did enough to warn people of the fast-rising waters. It's feared that the casualty count will climb with more heavy rain forecast in the coming days. In Iran, the supreme leader, Ayatollah Ali al-Khamenei, has appeared publicly for the first time since the 12-day war with Israel began last month. This according to Iranian state media. After weeks sheltering in a bunker, the New York Times reports that Khamenei attended an annual Shia religious ceremony held at his compound. Khamenei did not address the crowd, which appeared surprised by his appearance. Now, the end of the 90-day pause in higher U.S. tariffs is fast approaching. Let's get a sense of how markets are trading ahead of Wednesday's deadline. Our Bloomberg MLive strategist, Ven Ram, joins us from Dubai. So, Ven, good morning. Happy Monday. What is the path ahead for for the euro currency?
Morning, Francine. I think that the European currencies are on the whole going to be well bid in the second half, although I'm skeptical that their gains would be anything like what we saw in the first half. As you recall, the euro, the Swissy, and the Nordic currencies all averaged gains of some 15% in the first half, which I think is unlikely. Those gains are likely to be tempered. Why do I say that? Because, in the interview you had with Guindo's, ECB's Guindo's in Sintra last week, he said that, the ECB would be uncomfortable, kind of signaled the message that the ECB would be uncomfortable if those gains got beyond 120. So I think that increasingly the central banks in Europe will look at the nominal effective exchange rates and the real effective exchange rates and go, look, these gains are getting outmeasured or getting out of hand and are disproportionate to the strength in the economy. And therefore, even at a time when the trade deals are not yet stuck with the US, they wouldn't want undue strength in the currencies, because that means that there's going to be an additional tightening of financial conditions which will weigh on the exports. And therefore, I think the gains are going to be more tempered in the second half.
But, Ven, can U.S. stocks just keep on heading higher, really, regardless of all the risks to the U.S. economy?
Well, I think that, stocks are going to be maybe will have a Minsky moment, I think, going into the second half, because, they are overbought. They have got all the good news priced in. There's no bad news priced in, whether it's deficits or tariff. U.S. stocks have just shrugged it off. And if you look at the equity risk premium, Francine, I think at the moment it's kind of negative because you've got a PE of about, you've got an earnings yield of about 4.25 on the S&P 500, and you've got the 10-year Treasury yield at 435. So the equity risk premium is kind of negative, and that doesn't behave very well historically when that has happened. We have seen that there's been a major correction in equities. So I think that, you know, there's going to be a Minsky moment. When that will happen is hard to tell, but I think there is going to be one sooner rather than later.
Van, very quickly, is the moment of stress for UK labour market over now that the sell-off in gilts seems to have somewhat abated?
Well, I think that, you know, these risk-off episodes tend to occur in episodes, and we saw one episode in January, and now it happened last week. So I think that, you know, come the next budget, which is in autumn, I think that investors are going to sit up and take notice because, you know, there's no way, there's not much room for Chancellor Reeves to wriggle out of the situation because the fiscal headroom that she created is kind of imperiled by what has happened, and an increase in longer dated yields, and we are seeing that in Japan, we are seeing that in the US. If those yields are going to stay higher for longer elsewhere, I think gilt yields will stay higher as well, and that doesn't behove very well for the Chancellor.
Van, thanks so much. Van Ram there from our MLive team. Now, returning to geopolitics, and Israel has sent a team of negotiators to Qatar for talks with Hamas on a ceasefire in Gaza. Now, this coincides with a trip to Washington by the Israeli Prime Minister Benjamin Netanyahu to meet the U.S. President. So let's get more from our Dan Williams in Tel Aviv. Dan, what are we expecting from Netanyahu's meeting with Donald Trump?
Well, we're expecting actually for it to be surprisingly muted. It would appear that the two leaders are set to have dinner, but not an Oval Office meeting, at least not in the presence of journalists who might pelt them with questions about what really appears to be a serious juncture in this war, but not one with a predictable conclusion. There are negotiators in Qatar, that's one of the mediator countries. However, even when one discusses a proposed truce that Trump would like to see evolved into an end to the war, an open-ended end to this fighting, the sides are apparently in disagreement over the basic elements of that truce. So it's hard to know whether they'll make enough progress and whether the leaders meeting in Washington might at this point feel it's not ready for prime time.
Meanwhile, Israel's conflict with the Houthis in Yemen has flared up. Bring us up to speed with that, Dan.
Well, the Houthis of Yemen are the last Iranian-affiliated militant group that took part in this now 21-month-old war and are still openly fighting. They have kept up a sustained barrage of long-range missile attacks on Israel. There's some indication they may have also resumed attacks on shipping in the Red Sea. Overnight, Israelis were woken up by what appeared to be an incoming missile from Yemen. That was shot down outside Israeli borders. Now we're hearing that the Houthis are saying they fired 11 missiles at various sites in Israel. That does not appear to be true. It does not appear to be borne out either by the extent of the sirens or any kind of after-battle damage assessment within Israel. So at least performatively, the Houthis are saying they're still in the fight, even if Iran, their much more powerful ally, has now found itself in a ceasefire with Israel after their 12-day war of last month.
Dan, thank you so much. As always, Dan Williams there in Tel Aviv with the very latest from the region. Up next, Bloomberg Brief. Of course, I'll have a full roundup of equities, of tariffs and trade. This is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia But now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Lizzie Burden, in for Danny Berger all week with your Bloomberg Brief. Here's what you need to know. A rush for deals. Stock futures drop as trade tensions return ahead of the July 9th deadline. Secretary Bessent, though, hints at an extension. Fresh tariff threat. President Trump warns of an additional 10% levy as BRICS nations gather in Rio. And feud reignited. The president slams Elon Musk's announcement to form a new political party. Well, T-2. We are 2 days away from President Trump's self-imposed tariff deadline. Or are we? We have the Treasury Secretary saying that there could be a 3-week extension for certain countries. But then we have the president ramping up the pressure on the BRICS nations and saying that those tariff letters we were meant to get on Friday, well, they're coming today at noon Eastern time. And that is what the market is latching onto this morning, the escalatory language from the president. So futures lower, the S&P futures were down 0.5%. Now flip the board over to the Treasury picture. There isn't a whole lot of movement in either direction, but we've not got much on the docket for this week when it comes to the eco data. We're pretty light. We've got the Fed minutes, though, to look out for on Wednesday. But this risk-averse sentiment is weighing on euro dollar because we've got the dollar higher on the flip side. So we're down at a 117 handle for euro dollar. But let's take a look at some of the pre-market movers we're watching this morning. Joe Easton's with us for that. Joe, what's on your radar?
Hey, Lizzie. So we got a significant drop in Tesla this morning. As you mentioned there, it is all related to this news around Musk launching his own party, the America Party, and Trump deriding it, calling it ridiculous to reporters. We're seeing Tesla down 7% almost in the pre-market. Analysts saying they just wish Musk would get back to focusing on Tesla and the brand, therefore that weakness coming into the stock today. Then we've also got a bit of M&A. Capgemini here in Europe, the French company, going over to the US and buying WNS at a decent premium, around a 10% premium from where it closed on Friday. This is agentic AI, so AI that can operate on its own without human intervention, a really hot space at the moment, and WNS rising around 11% today. Then in the casino space, we're not spending enough money over in Las Vegas, according to analysts at Goldman Sachs, and they therefore give a sell rating to MGM Resorts today. They actually have a buy on Caesars, the rival, but both of those stocks are slipping this morning giving Goldman is negative on Las Vegas. And as usual, check out the Before the Bell opening wrap on the terminal for a summary of these news movers and more, Lizzie.
Excellent work, Joey. Thank you so much. And we'll catch up with you later again in the hour. Now, in just moments, we're going to be speaking to Anna Rosenberg of Amundi Asset Management. And later on this hour, Paul Weeks of Water Tower Research will be unpacking investor risks ahead of this week's tariff deadline. But we are just 2 days away from that self-imposed deadline from President Trump on his US trade partners. And Amundi's Anna Rosenberg has been weighing in. She writes, the most likely outcome is a combination of new deals being announced, some countries where talks are progressing, seeing a deadline extension, while some countries will be hit with tariffs. And I'm pleased to say that Anna joins us now. She's head of geopolitics at Amundi Asset Management. Welcome to the program, Anna. Good morning. I'm looking at all of this, and we've got the Treasury Secretary, Scott Bessent, indicating that there could be this 3-week extension. You've got the president ramping up the escalatory language. Who should we listen to?
Well, I think we should listen to both, right? This is exactly the tactic. You, at the same time, ramp up the pressure while you hint at an extension. I think that the extension probably aims at calming market reaction somewhat, saying, calm down, guys, this is not going to be as bad as you think. So I think we're seeing a combination of different things playing out here right now. And ultimately, I don't think it's going to change much, right? Because we haven't got a whole lot of deals agreed upon now. And this is because trading partners are wanting to see what will happen whenever the deadline actually hits, right? Are we going to see a lot of tariffs being implemented or not? You can always walk back and agree to deals once you have been hit with a tariff, like we saw with China, for example.
But the president's got the wind in his sails from passing the One Big Beautiful Bill. We know that we've seen the stock market hitting record after record. Do you have hopes of progress on deals by Wednesday then?
Well, I think we may be seeing, a few deals. It's very difficult to make specific predictions on the individual deals because everything that you hear that is being leaked to the press is part of the negotiation. So you could see some deals where we think, things are likely going to materialize, like the one with India, falling apart, right? Versus you're seeing some deals that are quite difficult to actually materialize, like the one with the EU coming to fruition. It's very difficult to really make a confident judgment call on these deals. But I think the fact that we kind of have an extension now is going to take the wind out of the sail of some of these negotiations, because why rush now when you have a few more weeks to negotiate, potentially get something else out of it?
And when you look at the Vietnam deal, of course, 20% is double the 10% universal tariff. So does that mean that actually the tariff rates in general across the board are going to be higher, closer towards the top end of the tariffs that the president's been threatening, when, we know that he needs this revenue to fund that big, beautiful Bill's tax cuts from Friday?
Well, I think let's wait and see here. I mean, again, the conclusion that many trading partners will have drawn from the deals that have been struck so far is that these deals are not great for us, so maybe we shouldn't be rushing towards them. Ultimately, the Vietnam deal is not good on paper for Vietnam, and indeed seems higher than those 10% universal tariffs. But let's take a step back here. Okay? Initially, when you go back and read the paper by Stephen Mirren that was published just before the election, there was a clear strategy here, and the strategy was we need 10% tariffs with everyone without retaliation. Now, how do you get that? Well, you get that by actually making much more aggressive demands, much bigger demands. And this is what Trump has done. He's gone in with much higher tariff demands, tariff expectations, and ultimately no one has retaliated yet. So if he walks away with 10% tariffs across the board, that's a pretty good outcome. Everything on top of that will be a bonus.
You talk about retaliation, Anna. We saw the EU-China summit ending early last week. Does that suggest that actually Brussels isn't going to be willing to roll over in the trade talks with Washington, and that actually President Trump should be braced from retaliation there?
So clearly, I think that's a very important point. You mentioned two important points. Firstly, the issue of retaliation, and secondly, China. So I think that we should expect some level of retaliation. The EU is historically a very tough trade negotiator. They don't make those deals easily, also because they have to coordinate amongst many member states, right? So I think that there is going to be an element of retaliation if this doesn't go into the direction that is useful for the EU. And it doesn't look like it at the moment, okay? So that's one thing. The second thing, on China, we have to keep in mind that what this is. we're having growing economic friction. The trade deals that the US has signed so far aim at sidelining China, okay? And China is taking notice. And we have already seen China flex its muscles over the last few weeks by limiting rare earth exports. If more of these deals sideline China, I think we should start to see China taking leverage again of those rare earth exports. So I think there's going to be more friction here.
When you look at the US-China relationship, of course, we've already had the talks in Geneva and London. We've got this framework agreed, but we've seen the US lifting these China chip design software curbs. And I wonder whether you look at that and conclude that actually President Trump's more focused on getting deals than he is on national security.
So, firstly, I think that the US-China relationship is going to continue to deteriorate, right? This is a great power competition, and China is catching up on many areas, and the US is not going to be happy with this. So, ultimately, right now, both sides are in a scenario of tense understanding. They both understand this is not a, they do not want things to escalate. But ultimately, what we have seen from China is, in the last few months, is a lot more confidence and boldness. And China is going to make use of this much more. So, I think, again, we are in this tense understanding scenario, but ultimately the relation will continue to deteriorate, and China will use its muscles when it has to.
All right. Anna Rosenberg of Amundi Asset Management. We're going to have to leave it there. So good to see you. Really nice to have you on the program. Thank you. Well, now to the other top stories trending on the terminal this morning. China hits back at the EU's restrictions on its medical device makers while maintaining key exceptions. The trade moves come days ahead of a meeting between the EU and Chinese leaders in Beijing that may touch on various issues, including the bloc's tariffs on a surge in Chinese EVs and Beijing's support for Moscow since it invaded Ukraine. Elsewhere, multiple small vessels attacked a ship in the Red Sea, causing a fire on board and prompting the crew to abandon ship before the Israel army carried out airstrikes on Houthi-controlled ports in Yemen. The IDF said the strikes were in response to the repeated attacks by the Houthis against Israel. A passing merchant vessel rescued all the crew members, while the ship remains abandoned. And this just dropping on the terminal moments ago, Apple appealed a $580 million fine from the European Union, calling the penalty unprecedented, and the regulators required changes to its App Store unlawful. The European Commission announced the fine in April under its Digital Markets Act, saying that the iPhone maker ran afoul of its rules relating to allowing developers to steer users to make purchases outside of its store. Well, coming up, July 9th approaches, but Besant and Lutnick suggest that nations have until August to avoid being hit with President Trump's reciprocal tariffs. We'll unpack the latest next.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign and Central Portugal, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
President Trump and US Commerce Secretary Howard Lutnick speaking there about the timings relating to the upcoming and so-called reciprocal tariffs. Treasury Secretary Scott Bessent also hinted over the weekend that countries would have until August 1st to make offers and reach trade deals. So joining me now to discuss is Bloomberg's Brendan Murray, who of course leads our global trade coverage. Brendan, the president says that he's delayed sending these tariff letters till midday New York time because the negotiations have continued over the holiday weekend. So what progress was made? Do we know who's closest to a deal?
Well, we know that the European Union was talking throughout the weekend. We know Japan was still in discussions. Countries such as Indonesia, India, South Korea, Switzerland are also near the finish line, but whether they can get over before July 9th is a big question. And what you heard Howard Lutnick saying there next to the president was adding a bit of wiggle room there to say the tariffs won't actually take effect until August 1st, when they've been saying all along they're going to take effect July 9th. So there's an extra 3 weeks. Now, 3 weeks isn't a whole lot of time to get over the most contentious of issues, but at least it kicks the can down the road so that there's a bit more time to get some of these more important deals economically in the win column for the Trump administration.
Yeah, so the strategic ambiguity continues, but what definitely sounds escalatory is the president threatening the BRICS nations with this additional 10% tariff. Brendan, what about them or their summit over the weekends prompted him to lash out in this way? How does it affect negotiations with India, for example?
Yeah, I mean, it throws a wrench in a process that's already having trouble coming up with a final deal. The president has long had an issue with the BRICS and the rivalry with the United States in the global trading system, and so this was an interesting point where the BRICS are trying to set up their own sort of power center, trying to portray themselves as the center of stability and economic prosperity, while Trump, on the other hand, maintains his role as disruptor in chief in this environment. So an interesting contrast there, where the BRICS are trying to stabilize or portray that they're stabilizing things, and Trump disrupting things with this new threat of tariffs.
All right, Brendan Murray, we thank you, and I'm sure you'll keep us posted on the latest out of Rio. But staying in Washington, Tesla CEO Elon Musk has said on Saturday that a new America party that he'd been threatening to launch has now been formed. That came the day after the president signed his tax cut and spending bill into law, which Musk, of course, has been opposed to. Now, Trump let reporters know his thoughts on that party.
It's always been a two-party system. And I think starting a third party just adds to confusion. It really seems to have been developed for two parties. Third parties have never worked. So he can have fun with it, but I think it's ridiculous.
Joining me now is Bloomberg's DC breaking news editor, Kasia Klimashinska. Kasia, what might Trump do about Elon Musk's new party?
Good morning. Just as you mentioned, President Trump had a big victory over the weekend. On Friday, he signed into law the mega bill with most of his domestic agenda in it, including tax cuts. And in this bill, there was also this electric vehicle tax break that went away. And that's possibly what triggered the reaction from the world's richest man, Elon Musk, who said over the weekend that he is setting up a new party, the America Party. And so this fight between the world's two most powerful men continues, with President Trump now saying, there is no chance this third party will succeed. But it does look like Elon Musk has a plan. He specified on X over the weekend that he's really going after a couple of seats, maybe 2-3 seats in Senate, and maybe 8 to 10 in the House. So as you mentioned, President Trump said this plan won't succeed. He already spoke on Truth Social. He can go farther, right? He can go after Musk's businesses. For example, he has said before he threatened that the federal government might withdraw some contracts. So there is already some concern on markets. I saw Tesla shares being down pre-market this morning. We'll see what happens when the U.S. market opens.
Yeah, the idea that actually Musk is taking his eye off the ball again when it comes to running his business. Too much focus on politics, it seems, for investors. But let's just also talk about this visit from Israeli Prime Minister Benjamin Netanyahu to Washington. He's scheduled to have dinner with President Trump later on. The BRICS summit over the weekend has given out this statement opposing Israel's war with Iran and the actions in Gaza. If we put it all together, does it look likely that there's going to be much progress towards a Gaza ceasefire out of Netanyahu's visit?
Exactly. So those two events are related, right? So BRICS had their summit over the weekend, and they criticized Israel's action in Gaza. And now today, President Trump will host Benjamin Netanyahu at the White House. This will be the third visit from the Israeli prime minister since President Trump became president again. And there is an expectation that Trump will announce some sort of a ceasefire, even as it's a very hard thing to agree on. But he's looking at getting Israel and Hamas to agree to a 60-day ceasefire, hoping that it will lead to some sort of a longer-term peace.
And will we see progress on the Iran nuclear issue as well? Because, of course, this was the whole reason that the U.S. struck Iran.
That's a great question. So clearly, President Trump is trying to use the momentum he has here from reaching a ceasefire between Iran and Israel. But we'll see how much farther he can get. Again, like there's this dinner today around 6 p.m. when the two men can talk, and we'll find out what happens.
Okay, Kasia Klimashinska out of Washington, we thank you. We'll catch up with you again later. And coming up on the programme, a look at what else is making headlines around the world, including those devastating, tragic floods in Texas. This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in New York. Time now for our front page news. A look at what's making headlines around the world. First up, the New York Times leads with the tragic floods in Texas. More than 80 people were killed in these disastrous floods that roared through central Texas on Friday, with rescuers still searching for survivors. Dozens, including 10 young campers from Camp Mystic and all-girls summer camp, are still unaccounted for. Next up, the Wall Street Journal reports that Columbia University's Board of Trustees discussed terms of a possible deal with the Trump administration. Sources familiar with negotiations say it would restore at least some of the school's federal funding. The exact terms of a deal are still being hashed out, and any deal could still fall apart. And splashing the Financial Times, Tony Blair's staff is participating in a project to develop post-war Gaza. The plan, outlined in a slide deck seen by the FT, reimagines Gaza as a thriving trading hub. It proposed paying 500,000 Palestinians to leave the area and attracting private investors to develop Gaza. Well, let's check in on these markets. You're looking at futures pointing lower in reaction to the trade news. Donald Trump stepping up his threats, at least towards the BRICS nations, and saying that those tariff letters that we were waiting for on Friday are coming today at noon Eastern, so we keep an eye out for them. He says they'll be going to 12 to 15 countries. So we've got S&P E-minis down 0.5%. The dollar stronger because of the risk-averse sentiment. And we've got the euro actually on the flip side weaker, about the same. We're at 117 for that. And when we look at your bond space, the 10-year Treasury yield currently is there. Weaker a basis point as we look to the long end of the curve. Just looking at oil, 4.35%, there we have it on the 10-year yield. My eyes didn't deceive me. Looking at the oil space, we actually have Brent stronger at the moment. Of course, we had the OPEC Plus discussion over the weekend, turning on the supply taps even more than expected. 548,000 extra barrels a day, up from 411,000 in May, June and July. So an acceleration of this strategic pivot away from restraint led by Saudi Arabia. JP Morgan and Goldman Sachs actually see $60 per barrel by Q4, but it seems by the looks of this morning's reaction that traders are more confident there is enough demand to absorb that extra supply. So Brent there trading up 0.2% at $68 a barrel, gold at $3,309 a troy ounce. Coming up, tariff tensions abound. We're going to be speaking to Paul Meeks of Water Tower Research on all of the risks ahead. Does this rally have legs? This is Bloomberg.
You have had a number of games overseas in recent years. And in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden in all week for Danny Berger with your Bloomberg Brief. Here's what you need to know. A rush for deals. Stock futures drop as trade tensions return ahead of the July 9th deadline. Secretary Bessent hints at an extension. And fresh tariff threat. President Trump warns of an additional 10% levy as BRICS nations gather in Rio. And feud reignited. The president slams Elon Musk's announcement to form a new political party. So it is crunch time, 2 days until President Trump's tariff deadline, or is it? We've had hints that some countries could get a 3-week extension, but markets seem to be more concerned with the president's threatening to slap an additional 10% tariff on BRICS nations and his threat that the tariff letters are coming today at noon Eastern time. So it's the escalation that futures are latching onto here. Quite a different picture to where we left things before the holiday weekend. US equities, of course, hitting a fresh record off the back of the jobs report. But now we have S&P E-mini futures down 0.5%. Now, when it comes to this Treasury market, it is a data-light week. We've got Fed minutes on Wednesday, but for now, yields pretty steady across the curve. The dollar higher on the risk-averse sentiment, and euro-dollar on the downside at a 117 handle. So let's have a look at some of the individual stocks that we're watching this morning. With that, Joe Easton's back. Joe, what are you watching?
Hey, Lizzie, so we have got Tesla significantly lower in the pre-market today. We're down close to 7%. Now, there is a twofold impact going on here. Firstly, Trump slamming Musk's new political party at the weekend, deriding it as ridiculous, spurring more concern that Musk is going to be distracted from Tesla. And also, the other element, the big, beautiful bill, removing fines for certain vehicles that don't hit emissions targets. And that was seen as a positive thing for Tesla. But removing that, hitting the stock this morning. So we're down almost close to 7% at the moment, 6.5 on Tesla. Then we've also got a bit of M&A. We've got Capgemini here in Europe, the French company, going over to the US and buying WNS. This is a company that does agentic AI, so AI that can operate on its own without human intervention, a very hot subject at the moment, of course, and we are seeing WNS gaining around 12% this morning. Then finally, casinos. We're not spending enough over in Las Vegas, according to analysts at Goldman Sachs. So they put a sell rating today on MGM Resorts, saying that that is the most exposed to Vegas, and also just general macroeconomic uncertainty. They do like Caesars, but that one's slipping. Both of those stocks are lower. Keep an eye on the casino stocks this morning, Lizzie.
Joe, I've never had you down as a gambler, but maybe you are up for a flutter.
Bit of football. I love a football bet.
All right, well, good luck to you. We appreciate it, Joe Easton, with our stocks to watch. Now, let's zoom out a little and look at the broader markets, because as I say, we've got stock futures edging lower this morning after we hit that fresh record again before the long holiday weekend on Thursday. Paul Meeks of Water Tower Research writes, quote, I think that US equities are a bit overextended, although there they may continue to be some post-big, beautiful bill euphoria to keep this rally going. Paul Meeks joins us now. Welcome to the show, Paul. Where you think that US equities are a bit overextended, what's the trigger point to sell? Because we're getting not too far from 6,300, for example.
I don't think it's necessarily a valuation level, either on an absolute or relative basis for a benchmark like the S&P 500. I think the key is the looming deadline on the 9th of this month for the tariff deals, or no tariff deals, or blended tariff deals. So I'm more worried about the geopolitical risk that could be the next catalyst, not necessarily worried that the market is too overextended on a valuation basis.
So you don't think that this market is becoming immune to trade headlines? Because I was wondering whether we were going to have a less volatile second half than the first half.
Excellent question, Lizzie. Here's what I think. First of all, we only have a smattering of deals that have been announced. Maybe we'll have a few more in the next few days. But what I expect is what Treasury Secretary Scott Bessent leaned into the other day. It looks like there'll be an extension to the beginning of next month. And will we have anything resolved by then? I don't know. But Liberation Day, which started to cause the drop in stocks, was April 2. And so when companies announced their last quarter results ended March 31, it did not include Liberation Day tariffs. And so it'll be interesting to see when companies report in a few weeks, the quarter ended June 30, if they have more to say about it, and also if we get some more information from the White House. But unfortunately, we haven't seen the impact yet on company fundamentals.
Yeah, when it comes to earnings, do you expect that the hit from tariffs is going to outweigh the boost from tax cuts?
I think tariffs for any company that is importing goods, particularly from China, is a much worse impact. Because even though they've tightened the tax loopholes over time for the corporate tax rate, companies still have relatively low rates, particularly multinationals that can steer some business to subsidiaries abroad that pay no taxes or low taxes. So to answer your question directly, much bigger threats, in my view, the tariff versus any positive boost in a lower tax rate.
And when are we going to see the uncertainty that's already been revealed in the survey data show up in the hard data? I'm thinking about the inflation print that's upcoming next week.
Yes, we haven't seen that yet. It appears that the economy has been quite resilient. More data on that last week. But yes, when I see consumer sentiment soften, and in this country, the consumer spending is 70% of U.S. GDP, that does worry me. So again, I'm waiting for resolution, both on these tariff deals and also on does the soft data, which is turning downward, ever find its way to the hard data.
And as a primarily tech investor, if you look at the jobs data, of course, we've got the jobless claims coming up later on this week. It seems like companies are hoarding workers. They don't want to hire, they don't want to fire. And a lot of analysts have been putting that down to all the tariff uncertainty. You know, they don't want to make a decision till they know what's what. Are we actually getting all this wrong, Paul? Is it actually the case that companies don't want to hire anybody because they've got AI to do the work that humans were doing?
I think they don't want to hire folks for two reasons. One is everybody is telling us, the CEOs of major companies, that perhaps over time, 50% of these jobs are replaced by AI. But it's also, think about if you are the CEO or CFO of a company and you're trying to plot your budget, and with all this madness and these unresolved issues, you probably do not want to spend too much until you get some clarity that I was talking about a few minutes ago. And so I think those are the two big, they're not drivers, let's call them obstacles.
Paul, thanks so much for joining us. Great stuff as always. Paul Meeks of Water Tower Research. Now, to some other top stories trending on the terminal this morning. China hits back at the EU's restrictions on its medical device makers while maintaining key exceptions. The trade moves come days ahead of a meeting between the EU and Chinese leaders in Beijing that may touch on various issues, including the blocked tariffs on a surge in Chinese EVs and Beijing's support for Moscow since it invaded Ukraine. And multiple small vessels attacked a ship in the Red Sea, causing a fire on board and prompting the crew to abandon ship before the Israel army carried out airstrikes on Houthi-controlled ports in Yemen. The IDF said that the strikes were in response to the repeated attacks by the Houthis against Israel. The passing merchant vessel rescued all crew members while the ship remains abandoned. And Jurassic World Rebirth scored the top spot in theatres over the 5-day 4th of July holiday, grossing more than $147 million in the US and Canada, topping estimates. The film is the 7th entry in the Jurassic franchise, which has taken in over $6 billion in ticket sales since the first release in 1993. Well, coming up on the programme, Secretary Bessent hints at a tariff extension as the deadline looms. More next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
US trade partners are rushing for a deal ahead of Wednesday's tariff deadline, as the Treasury Secretary Scott Bessent hints over the weekend that countries would have until August 1st to make offers and reach deals. Joining me now for more is Bloomberg's DC Breaking News editor, Kasia Klin-Mashinska. Kasia, good to see you again. Look, these country-specific tariff rates don't kick in until August, according to Lutnick and Bessent. So I'm just wondering what happens when the July 9th deadline passes then.
Good morning. So I think the U.S. Commerce Secretary Howard Lutnick specified it best, right? The tariffs kick in on August 1st, but President Trump is setting the tariff rates and deals now. That means that this week, actually as early as noon today, we will find out what are some of the new tariff levels for some key U.S. trading partners. And then later this week, President Trump maybe will announce some trade deals or some broad trade frameworks, and he will send more letters to more U.S. trading partners. Then there's additional 3 weeks for further negotiation. But remember, we already had 3 months, right? President Trump announced initially those higher tariffs on April 2nd, and since then the U.S. has been negotiating with, as Trump said, about 200 countries, but we have very little to show for that. There is some sort of an agreement, some sort of a framework with the UK, there is an agreement with Vietnam, and there is the very important thought with China. But as far as the other countries, we have to see whether there will be more agreements, more deals, or just those new tariff levels, which would indeed then kick in next month.
Well, yeah, the president's threatened BRICS nations with an additional 10% tariff. So does that mean that there's zero hope of an India deal by Wednesday?
That's indeed very interesting, because we know that the US and India have been negotiating over the last couple of months, but we also know that India is a very hard trading partner. So we will have to see whether, again, this week, whether there is a new sort of agreement, a framework, or a new tariff rate for India.
And speaking of opposition, Kasia, the president's finding some in his old friend Elon Musk. Just how has he taken the news of the Tesla CEO's new America Party being formed over the weekend?
Yes, so this fight between the world's two, maybe the two most influential men, is escalating, with Elon Musk saying that he has in fact formed a new political party, the America Party, and President Trump saying that it has no chances of succeeding, going personally after Elon Musk. Remember that just on July 1st, President Trump said that Elon Musk perhaps took in more subsidies, federal subsidies, than any other human being. So there is a risk there, obviously a potential threat of President Trump withdrawing some of this federal funding for Musk companies such as Tesla or SpaceX.
Kasia Klin-Mashinska out of Washington, we thank you for the great coverage. And I want to stay on Musk's America Party, because President Trump has let his views be known, as Kasia says. But what does the party mean for Elon Musk and for Tesla? Let's bring in Bloomberg's Craig Trudell, who of course leads our global autos coverage. Craig, we've seen Tesla shares down more than 6% on alternative trading systems ahead of the Wall Street Open on Elon Musk's latest foray into politics. I wonder how much that reflects a fear of blowback from the president, and how much actually it's a fear that Musk's taking his eye off the ball again.
I think it could be a little bit of both here, right? Where you've sort of maybe reckoned that just, after the first of the sort of blow-ups between these two, that there would be some recognition that there's a lot of risk involved for Musk at continuing to sort of poke the bear and go after Trump. But he hasn't really been able to help himself. He's sustained his criticism of the president's spending bill. The president has attempted to try and turn this into, he's just, exercising, this is all just sour grapes over EV tax credits. I do think that, Musk has been pretty consistent over the years talking about deficit spending and the U.S. needing to get its budget in order. And yet, how he sort of, reckons with that, whether or not it's the smartest move to sort of now go from taking on the Democrats to taking on both parties, and in the process, take himself away from his companies. I think that's the concern if you're a Tesla investor.
Come on, Craig, tell me, do you think he's serious about making this party a success?
I think he's got the money to do it. I think he's also very dug in here. He's also, I would say, really sort of put himself out there as, with some specifics, right, of I'm going to target a handful of members of Congress, some seats in the House and in the Senate. And he's also, saying already that he's not ruling out the possibility of getting behind a candidate for president. So he's sending every signal at this point that, this will be, something he's focused on for the next year and potentially, years out. And that's, again, just a concern if you're invested in this company, because his political, machinations have been such a distraction for him and a reason for some car buyers to say, yeah, no thanks, I'll pass on a Tesla.
Well, look, just because you can doesn't mean you should, Craig. That's what my mother told me. Craig Trudell, thank you for that update. Now, let's stay with tech, because Foxconn, a provider for both NVIDIA and Apple, has reported more than 15% growth in quarterly sales as robust demand for AI servers and iPhones persists. Now, this comes as it navigates geopolitical shifts and trade tensions. Joining us for more is Bloomberg's Newly Purnell. And Newly, just talk us through what this tells us about the strength of AI demand.
Yeah, you're right. They're really a proxy for demand for these new kind of AI chips and services. They posted $62 billion in revenue, which was a good figure. It was in line with what analysts expected. So, yeah, I think we can say that shows that demand is holding steady. It's also really good news, actually, for China, for Apple in China, because Counterpoint, we reported the other day, came out with some research about robust demand for Apple's newest phones there. And of course, Foxconn being a big manufacturer there, I think it's probably also good news for Apple. Yeah, but definitely AI services demand is holding steady.
And how vulnerable is Foxconn to potential tariffs?
Well, they're caught right in the middle, right, of this U.S.-China trade war. Case in point, we saw the recent news about the new tariffs coming to Vietnam, and Hon Hai, like many global tech companies, has been trying to diversify its supply chain, its operations into other countries, precisely countries like Vietnam. So they're caught in the middle of this, and they actually earlier this year, Hon Hai revised down their expected revenues for the year. One interesting thing that we might be seeing actually is that some companies, observers say, might be upping their orders in anticipation of new tariffs coming, so they might actually, in a counterintuitive way, be benefiting from some of this turbulence.
Okay, that's really interesting. And meanwhile, I was waiting for this Grok 4 release. Musk told us that it was going to come just after July 4th, but there's no sign of it yet. Just talk us through maybe why it's been delayed, and if we know anything about what will be different between Grok 3 and Grok 4.
Right. Well, we're a few days on now, of course, from July 4th. I just did a quick scan of his recent postings on X. I haven't seen anything. He's been talking about his America, new political party, of course, you were just discussing. Someone tweeted, or I should say, I posted on X that that the Grok 3 appears to now be able to interpret memes, so he responded to that. But no news yet on when the new version could be out. Why is it important? I'll give you one word: money. We reported that X.AI, the AI wing, has been burning through something like $1 billion a month in cash as it seeks to develop these new models and build out its infrastructure. Musk then took to X to dispute that report, I should say. But it's expensive to do this stuff, and what we might expect from the new version, just better all around. It could have more data, it could be faster, it should have fewer hallucinations. So just in the way that all these models should get better, the more money and the more resources you pour into them, that's what you would expect from Grok 4 as well.
Already getting distracted, you might say. Bloomberg's Newly Purnell, we thank you for the latest there on Grok, which we're still waiting for, maybe tomorrow. But coming up on the programme, we'll get you set up for your trading week next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in New York. Let's take a look at what's ahead this week. President Trump's tariff deadline is coming Tuesday night into Wednesday morning, but Treasury Besant has hinted at an extension. Also on Wednesday, we'll get the latest Fed minutes, and then on Thursday, another round of jobless claims. Remember, on Thursday, we had the stock market hitting a fresh record off the back of the jobs report and traders pulling back their Fed cut bets as well. So we look ahead to what comes out of that. In terms of your micro movers right now, we're looking at WNS off the back of Capgemini, looking to buy for $3.3 billion to boost its agentic AI. We're looking at Tesla as well, falling because of Elon Musk forming this new political party. And then, of course, we're keeping an eye on Apple as well because the iPhone maker Honhai, aka Foxconn, has met its sales estimates. So we are weaker there in the pre-market when it comes to Apple. Let's also turn to the macro story before we're over and out here. We have had that OPEC Plus decision over the weekend to keep turning on the supply taps, more actually than previously expected. In May, June and July, they'd gone for 411,000 barrel extra hikes, and this time they've gone for 548,000 barrels extra a day. But when you look at the Brent reaction this morning, actually we're higher by 0.6%. We're currently at $68 a barrel off the back of this. You might have expected oil to fall, but it seems like traders have realized that there's enough demand to keep up with all of this supply. We had Goldman and JP Morgan estimating that by the fourth quarter you could see oil falling to $60 a barrel. Doesn't look like it this morning, but of course things could change. But look, this is an extension of that strategic pivot by Saudi Arabia. Bit of a nightmare for President Trump. Yes, he wants lower oil prices to help deal with inflation, but at the same time, what could it all mean for the US shale industry if we do actually see oil prices falling? It's been a pleasure being with you this past hour. I'm with you all week in for Danny Berger. That does it for your Bloomberg Brief. Surveillance is coming up next. This is Bloomberg.
cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
The fact that the unemployment rate is going down is something that, of course, is quite surprising.
It feels like a lot of optimism has been priced in the market, but we do expect a soft patch later this year.
The story here is not the headline.
If the labor market's okay, their urgency to cut goes down.
Base case, we have them not cutting. Certainly July is off the table.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, attention shifting from taxes to trade.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
The White House preparing to set tariff rates in the face of shifting deadlines. As President Donald Trump signs his major tax and spending bill into law, the Tesla CEO, Elon Musk, unveiling his bid to start a new political party, putting Tesla stock back in a spotlight.
A lot to digest this Monday morning, especially as we have this tariff deadline looming. It really feels like parallel tracks, though, Jonathan. The president, very late last night, putting out a Truth Social post saying that there will be deals announced today, letters, trade and tariff letters sent to a number of countries by noon today. At the same time, his own Commerce Secretary and the Treasury Secretary talking about now August 1st. So it feels like the deadline is shifting, and it always felt like this deadline was a bit fluid.
So July 9th was the self-imposed 90-day pause. That's in a couple of days' time. August 1st is when the tariffs kick in. And after Secretary Besson spent over the weekend, a lot of people just assume there's some space here to negotiate. Now, the president also said, just to confuse things even more, the letters will go out at noon today.
Right. So what this all says to me is very simply, they do not have the deals done yet, because the second a deal seems like they are close and at the finish line, the president takes to Truth Social or has a press conference in the Oval Office, like he did with the United Kingdom, like he did just a few days ago with Vietnam. So they're still working through a few details, clearly. The Treasury Secretary is talking about 18 trading partners. We have been saying for weeks, when you speak to the other side of the table that are negotiating with the White House, they say if you are negotiating in good faith and they feel like you are far enough along, the White House has told them that they will give them the breathing room and the space beyond July 9th. July 9th is Wednesday, so a lot of those trading partners are going to get more days.
That's the focus coming into a brand new trading week. The single name focus so far this morning, one name, Tesla, in the pre-market, down by more than 6%. One quote from Elon Musk, enough to wipe out some serious gains on this stock. You want a new political party? You shall have it.
Well, what you're seeing right now is the feud, once again, back in play between Elon Musk and the President of the United States. This is not what investors or the board of his companies wanted to see when they saw him leave the White House and leave Doge. Dan Ives, who we're going to be speaking to, says that exactly, very simply. Musk diving deeper into politics, now trying to take the Beltway establishment, is exactly the opposite direction that investors and shareholders want him to take during this crucial period for the Tesla story.
More on this stock a little bit later this morning. Down hard in the pre-market. Futures doing okay on the S&P 500, negative by about 0.25%. Coming up this hour, we'll catch up with Steve Chevron of Federated as a risk-off mood returns to markets. Dan Ives of Wedbush on Elon Musk's new political party, and Andrew Honhorst of Citi following a stronger than expected jobs report. We begin this hour with stocks falling ahead of President Trump's Wednesday tariff deadline. Steve Chevron of Federated writing the following: the market will get comfortable with the new levels, especially against the background of much greater certainty, pro-growth fiscal policies and monetary easing on the horizon. Steve joins us now for more. Steve, welcome to the program, sir, and I hope you had a fantastic July 4th long weekend. Let's get straight into this and your expectations for a couple of days' time. What are you expecting from this White House?
I think you've got a last-minute negotiation push here. I mean, I think that's what some of the uncertainty is around. Clearly, you know, having put pressure on, the administration is looking for that last bit of pressure to get these deals where they want them to be. I think that's what some of the threats are. I do think, though, there's some information around the Vietnam deal. I think the Wall Street's been looking for a kind of 10% around the board rate. The Vietnam deal suggests to me that maybe that number is a little bit higher. So I think you could see a little bit of indigestion this week. I think the market may have to become comfortable with a number that's north of 10% as the kind of standard rate. But again, with energy prices lower, with the tax bill now behind us, with earnings estimates stabilized, I think the market will be able to digest that over, you know, the course of a week or two and continue to move higher. But this week is going to be a little tricky, I think.
Steve, just to sit on trade just a little bit longer, difficult, of course, to guess the number, but I think we can guess the direction of travel here. Higher than where we were in January, maybe lower than where we were after April 2nd. Can we draw any conclusions about how companies have responded in the last several weeks? Just get an idea of who's going to pay these tariffs. Do they pass them on to the consumer, or are we going to see them take it on margins?
I think it's going to be, I think it's a combination of both. I mean, I think if you've got an item where demand is inelastic, you may see some prices pass through. I think in other cases, you might see it eaten in margin. In some cases, it might be eaten by the importer. I'm sorry, the exporter rather than the importer. And so I think it really is a combination of all three, John. And I think that's the administration's idea here, is that if tariffs are a tax and roughly half of that is going to be paid by the exporter, either through a stronger currency or by them eating it on the margin on their side, that you're really using that revenue to fund the extension of the Trump tax cuts, but only about half of it is paid by the U.S. kind of tax base.
When do you think?
But it's all three.
When do you think, Steve, will actually see clarity on who is actually eating the tariff? Because the deadline just keeps shifting.
I don't think that's a policy thing, Anne-Marie. I think it really is about the currency. You know, we've seen the dollar weaker the first half of this year. I think a lot of that has to do with the way that the government financed itself ahead of the debt ceiling. You're spending out of the Treasury general account. You're flooding the system with dollars, higher supply of dollars, kind of lower value. I think now that that's behind us, that you've passed the one big beautiful bill, it's going to be very interesting to see what the dollar does, I think, over the next, you know, let's call it a couple of months. And the higher that dollar goes, the more it's suggesting that it's foreign payers that are eating the tariff. But we really don't know that yet until, you know, we've gotten past the debt ceiling kind of issue. So next couple of months are going to be really telling there.
You think that still, though, the market will grind higher. How does it continuously grind higher in the face of a number of uncertainties?
Well, those uncertainties, which, you know, were kind of holding the market back earlier in the year, have become a wall of worry, right? There was concern that you weren't going to get the one big beautiful bill done. It's done. There was concern about geopolitics. We've started to see that settle. There was concern about energy prices. Those have come down. There's concern about tariffs. But again, we know what the worst case is for tariffs. The worst case for tariffs was what happened on Liberation Day, was those levels. And whatever's going to be implemented is going to be less than that, with key countries likely to get across the finish line. So, look, being bearish is always easier because you can point to all of the things that are, you know, potentially negative in front of you or that are negative today. The reality is the line moves up and to the right because businesses adjust. And we've got companies that got through COVID when we shut down the economy on a dime. I think we can get past what's essentially a sales tax. And so I don't think what you have here is something that's a long-term destruction of the economy. It's a tax, and companies will figure it out and we'll move higher.
Well, Steve, let's worry about something else, because there's always something else to worry about. Let's worry about the data. Payroll's out on Friday, or rather Thursday, going into the long weekend with the July 4th holiday on Friday. This is what Citi had to say about the numbers. Solid headline, fragile details. There is a worry about maybe some cracks forming beneath the surface, and maybe those cracks come to the surface as we work our way through summer. Why isn't that something to be concerned about for you and the team?
Yeah, so I think what you see is that the labor market has slowed. I don't think there's any question about that. But what you're seeing is not that there's mass layoffs. You're seeing just a slowing of hiring, a slowing of churn. And I think that that's what the job number really suggested on Friday, that you still have a solid labor market, although be it a little bit slower, with some cracks in it. And I think that that's really kind of what the market has come to internalize with the, a series of data over the last couple of weeks. Now, the question is, how does the Fed respond? And I think what you've got there in the Friday number is a number that was strong enough that you don't need to be overly concerned about the labor market. That's the good news. Soft enough that the Fed still does need to be marching towards a cut. Now, maybe it doesn't need to be July, but I think it certainly needs to be, or September certainly needs to be in the discussion. And that's something that we've talked about over the last several weeks. And so I think it was a number that was kind of, I don't want to say Goldilocks, but it was a number that was strong enough to give you confidence about the economy, but weak enough to suggest that the Fed is still in play. I think the market is comfortable with that.
Steve, that slowdown that we've started to see in the underlying data in the labor market, for instance, do you expect to see any of that in corporate earnings and the outlook that we might get from companies through the next week? Delta Airlines this week, the likes of JP Morgan kicking off bank earnings next week. What's going to be the outlook from them?
Well, I think it's going to be industry dependent. I mean, I think, look, credit looks good still. I think the labor market looks broadly okay. I think the banks are going to be in a good shape. I think you could see net interest margins and net interest income a little bit better than expected. And I think ultimately what could be the surprise on the earnings side, I don't know if it's this quarter, but it's either this quarter or next, is that now in the face of greater tax certainty, with greater tariff certainty likely to come at some point, but hopefully over the next month, I think you can see earnings estimates probably next quarter and into next year actually start to rise. I think you can get into a beat and rise scenario because the max uncertainty faced by corporates was really the last couple of quarters, and that is kind of waning. I think you're going to see companies get through this quarter, but as you get into the third quarter and they're starting to project earnings for next year, I think you're going to see a kind of beat and raise scenario that is the next leg of the market driving higher.
Steve, just on that point, are your confidence levels on that story higher for certain sectors versus the others, or is this just an index level story you see improving in the months ahead?
I think it's going to be better for cyclical sectors. I think it's certainly going to be better for sectors that are domestically focused. I think you're going to see smaller companies have more of an upside there than you would some of the larger companies, particularly because those tax rates and some of the tax policies will really matter more for them, as does deregulation. I think maybe some of the defensive sectors have gotten a little bit expensive in the first part of this year. You've seen them underperform a bit as cyclicals and growth and small caps have taken over. So I think you will see it at the index level because I think that's enough of the market to drive the index level. But I do think there are winners and losers here. And I think the bigger winners are those parts of the market that are tied to the economy staying stable, getting a little stronger, those that are a little tax sensitive, and those that are more domestically focused.
Hey, Steve, appreciate the update. As always, Steve Chevron of Federated, still constructive and bullish this equity market. Equity futures recovering somewhat, still down by 0.25% as we ease our way into a quieter trading week. This week, we'll get FOMC minutes on Wednesday, the same day we see that self-imposed deadline expire, the 90-day pause on tariffs. Next week, things really pick up. Bank earnings and CPI. Look out for that a week tomorrow. Equity futures recovered just a little bit then in the last 10 minutes or so. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Good morning, John. We begin with the deadly flooding in Texas. Rescuers there are still searching for survivors after catastrophic events over the weekend. The flooding killed more than 80 people, including many children attending youth camps. It's feared the casualty count will climb with more heavy rain forecasts in the coming days. Meanwhile, the Trump administration is preparing to send tariff letters to dozens of countries with its 90-day tariff pause set to expire this Wednesday. Speaking alongside Commerce Secretary Howard Lutnick, as you can see there, President Trump said most nations will have a deal or letter by then. Lutnick said the new tariff rates will go into effect on August 1st. And Elon Musk says he has formed a new America party after President Trump signed into law his tax cut and spending bill that the former First Buddy repeatedly denounced. Musk made the announcement in a post on X after 65% of respondents to a poll backed the idea. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. That stock, Tesla, down by 6.3% in the pre-market. Up next on the program, Trump giving final notice.
Sending letters out on Monday having to do with the trade deals. Could be 12, maybe 15. I think we'll have most countries done by July 9th. Yeah. Either a letter or a deal.
July 9th, just 2 days away. Looking ahead, Terry Haynes of Pangea Policy joins us next. Live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tesla, the one to watch in the pre-market. The name is down by more than 6% this morning. Plenty of reaction to this. Dan Ives of Wedbush saying very simply, Musk diving deeper into politics is exactly the opposite direction that investors and shareholders want him to take. Dan Ives is going to join us in about 15 minutes' time. That's a single name story in the pre-market. More broadly, equity futures doing okay. Equity futures negative by only 0.25% on the S&P. On the Nasdaq this morning, negative by 0.4. Under surveillance this morning, Trump giving final notice.
Sending letters out on Monday having to do with the trade deals. Could be 12, maybe 15. Some will go out on Tuesday and Wednesday, and we've made deals also. So we're going to have a combination of letters, and some deals have been made. I think we'll have most countries done by July 9th. Yeah. Either a letter or a deal.
So here's the latest this morning. President Donald Trump saying the U.S. will send letters to trade partners starting at noon today, as his pause on higher tariffs is set to expire on Wednesday. Joining us now from the nation's capital is Bloomberg's Tyler Kendall. Tyler, a lot of people waking up in this market this morning with one question after all the comments over the weekend. Just what is the actual deadline?
Yeah, hey, John, good morning. Well, the administration has signaled that perhaps there's some leeway here in terms of a perhaps 3-week extension. Administration officials have said that they're going to send out the letters in the coming days, but the levies aren't going to go into effect until August 1st. And we heard from the Treasury Secretary, Scott Bessent, in an interview over the weekend saying that the administration's playbook is what he called maximum pressure, that they're hoping by sending these letters that will light a fire under the trading partners to essentially put their best offer on the table. Now, President Trump said that these letters are going out to 12 to 15 of our trading partners. We know the White House was negotiating over the holiday weekend with officials from economies that have long been prioritized, including South Korea, Japan, India, the European Union. We should also probably note that officials from Vietnam were here in Washington. Even though we've already gotten an announcement of a framework agreement, it's clear that things are fluid and they're still ironing out the details. I will also add that the Treasury Secretary said that at the end of the day, they're likely to send 100 letters or so, because that will include some of those smaller countries that don't do as much trade with the U.S. and are going to face probably that 10% baseline tariff. But I bring it up because it probably previews a little bit of the messaging that we're going to hear out of the White House in the coming days, with the Treasury Secretary saying that these would basically amount to the so-called deals, even though it doesn't appear a lot of negotiating was done, because, John, these are the rates they're going to have to pay if they want to do business with the U.S.
Tyler, do you have a sense of the pecking order right now? Who actually is going to get a deal by the 9th? That is a framework outline like we saw potentially that the U.S. did with the United Kingdom?
Well, it's actually, Anne-Marie, been really interesting to see how some of these economies that have been prioritized, those economies in Asia that are geographically close to China, have sort of been shifting in terms of the order. Take Japan, for example, with President Trump has recently ramped up his threats against because of some of the sticking points in the negotiations there, particularly when it comes to the sector-specific tariffs related to autos. We're seeing sort of the same messaging when it comes to India. Of course, President Trump ramped up his comments and his threats against any nation he says are aligning with anti-American policies of BRICS countries after a summit of those nations over the weekend. But India has also said that they're prepared to launch retaliatory tariffs, something that the administration doesn't want to see and likely isn't liking the sound of that, particularly when it does come to also negotiating those auto tariffs. So that's been a really interesting dynamic. These are the countries that we were expecting agreements, but it is clear that there's still a lot of issues that they need to work out.
Tyler Kendall with the latest. Tyler, thank you, down in Washington, D.C. Anne-Marie, still trying to figure out who's at the front of the line here and who's at the back. This is the latest from Europe this morning, from the EU Commission. The President and von der Leyen, the EU Commission President, spoke by phone over the weekend.
Yep, the EU is still trying to work towards this Wednesday deadline. They want to get a framework in place when it comes to the agreement. They don't want to be lingering when it comes to the line of who's in the front of the queue. What's so interesting is that the European Union seemed to be on the back foot with this administration, but the last 3 weeks or so, it really changed in terms of the outreach and what they were willing to agree to. Remember, it was just 2 weeks ago they said if there was a 10% across the line base when it comes to tariffs, there was going to be reciprocity from Brussels on Washington. And then all of a sudden, that disappeared, that evaporated, and now they seem to be willing to be able to take more, not have as many concessions.
This from the Commission just moments ago. The EU still working towards the July 9th deadline for a trade deal with the United States, seeing progress in talks towards that trade deal. Joining us now to extend the conversation, Terry Haynes of Pangea Policy. Terry, good morning. Stocks at all-time highs. We've passed the one big beautiful bill. Does that embolden the president to go hard this week?
Well, I think it puts more pressure on the president to get some clarity here, frankly. And the president continues to. It's not my opinion. The president continues to invite that by saying things like, we're going to have letters or deals. So, I think we all agree here from our conversation this morning that what you're going to end up with is not quite that. You're going to get frameworks of deals. You're going to get aspirational deals. You're going to get a variety of positive movement, which will be markets positive, and you're also going to get some clarity on the letters on the other side. So, I mean, all this is generally speaking markets positive, but it'll still be a bit of a muddle.
It does feel like a muddle, because if you're getting a letter, you're not getting a deal. I thought the whole point of Trump doing this maximalist approach was to get good deals at the end of the day. Why don't they just kick the deadline down the road even more?
Well, they are to a bit, and I don't see the deal delays on tariffs to August 1st as yet another delay. I see it more as, here's 3 weeks for those of you who haven't taken us seriously to take us seriously, and see if we can't kickstart something. But generally speaking, the lesson markets will learn is that the president's on track to put a lot of this stuff to bed over the next weeks and months, and that's probably good news.
Steve Chiavone brought up a really good point. Everyone was thinking that there was going to be a 10% baseline tariff, but then when Trump came out with the Vietnam deal, which was 20%, and then for transshipping 40%, that 10% quickly evaporated, and people are starting to think maybe the rates are going to be higher. Can we see a lot of these countries get rates that are higher than 10%?
First, Steve's the best, and secondly, the how I would put that is, you look at the specifics of Vietnam, which is, among other things, a prime is used by China for transshipment, and so I think, generally speaking, where there are other countries that have similar characteristics of Vietnam in terms of transshipment, you're going to see that kind of backfilling, and where not.
What does the market want to see in terms of the countries that the administration is prioritizing and could try to get a framework by this Wednesday?
Well, I think markets want to see any progress at all. Generally, I would offer that the country I would look at is India, and the reason why I would look at India is because not only is it a major world economy, not only is it a country that the United States, both the United States and India, have prioritized in terms of getting a deal, but we're also just coming off this BRICS conference that involved India. So the market, or excuse me, the political view and policy view of getting India to so clearly side with the United States in terms of a trade deal would send a pretty powerful message to lots of economies in the world about what the United States is willing to do to increase interdependence.
Terry, just one more beat. Let's take it away from trade. Let's talk about domestic politics. The New America Party. Congress, as you know, is operating with really thin margins down in Washington, D.C. If Elon Musk really pursues this, could this upset the midterms?
There's potential for that right now, but it's really, really far away. We're looking at 18 months out, so anything anybody says today isn't, I think, doesn't have much validity for the result. I will say this about Musk. There's five things Musk needs to do to provide a credible alternative. First, he's got money, certainly. Secondly, he has to have a credible brand, and he's torched himself with the most engaged political people on both the left and the right. So I think the brand is kind of torched. Thirdly, you got to have some trust in the project, and probably not if your brand's bad. Fourthly, you got to have a plan, and there isn't any. And fifth, you have to show that in the past you've had some results, and he didn't have any with Doge. So I'm thinking it's a kind of a marginal revenge project.
Terry Haynes of Pangaea, appreciate your opinion, sir. Thank you. It's certainly hitting the stock so far this morning in the pre-market. Up next on the program, Dan Ives of Wedbush on Elon Musk's New America Party, plus Yahira Anand with your morning movers and the impact on shares of Tesla. We're down by 6.5%. From New York, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Two-day winning streak going into the long weekend on the S&P 500. Record highs coming into a brand new trading week. It's a 2-week winning streak on the S&P. Equity futures this morning, negative by just 0.25% on the S&P, staring down a series of deadlines. Is it July 9th, August 1st? We'll debate that throughout this morning with 3 hours until your cash open. Let's get to your morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We start with our big mover of the day, and that is Tesla, down now 6.7% after Elon Musk launched his new political party, delving deeper into politics and drawing fire from President Trump. With two things investors and your next guest, Mr. Ives, obviously do not want to see at a time when Tesla sales are falling worldwide. And next up, we turn to some M&A news. We have WNS here. France's Capgemini is buying this U.S.-listed company, and as a result, shares are soaring 13%. And this is really an AI play by Capgemini, which is an IT services firm. It wants to be able to provide its clients with agentic AI, which we all know can make decisions on its own. And instead of developing that type of technology on its own, it's going out and buying a company that can already do that. And we end with Geo Group and Core Civic. If you are unfamiliar with these names, these are the two largest operators of immigrant detention centers in the U.S. Geo Group is up 7.5%, Core Civic up 2.4% after President Trump signed his massive tax and spending bill into law, which triples federal funding for detention centers as part of his broader crackdown on immigration. So these are two clear winners from that. John?
Yahara, thank you. More from Yahara later on this hour. On a raise out this morning, President Donald Trump threatening an additional 10% tariff on any country aligning themselves with the, quote, anti-American policies of BRICS. This coming as the U.S. prepares to send out tariff letters to dozens of trading partners.
This is why Terry Haynes is perfectly right when he says India is going to be really important, because this is an ally of the United States. Modi made this trip very early on in the Trump administration, just after he was inaugurated, to get ahead of it. He knew the tariffs were coming down the pipeline. India is now talking tough, saying potentially they could retaliate, and they are part of BRICS. And the president is saying if you're part of BRICS, then you're going to get an even extra penalty when it comes to these tariffs and trade deadlines.
So does China get an extra 10%?
Well, with China, it's interesting because we still don't have the details of the framework the administration continues to talk about when it comes to the Geneva and London talks. I was there at the London talks. Where is the language? We do not have the deal that they've put out. We know it's about rare earths. We know it's about export controls, but we don't actually have the final framework. And what it feels like with China is people are saying this is a deal. This really isn't a deal. Both sides knew that they had to de-escalate from where they were. Is it a grand bargain deal? Where's the purchasing agreement? Where's TikTok? There's a number of questions when it comes to China and Washington that still linger.
The president looked to make an example out of China just a few months ago. I wonder this time around who will be made the example of. It's not going to be Europe, based on some of the conversations we've heard over the past few weeks or so. Will it be Japan? Based on the direction of travel over the past few days.
Isn't it so interesting that everyone said that India and Japan were top of the list, Europe was bottom of the barrel, and now we are getting ever so close to July 9th, and it looks like the European Union is pushing all they can to try to get this deal over the finish line. The Treasury Secretary over the weekend was talking about the fact that it wasn't just Ursula von der Leyen. The president has had some frequent phone calls now. We know that they just had one yesterday, but a number of countries, heads of state, reaching out to the president saying, we want to make sure we get a framework and an agreement. When it comes to Japan, they're dealing with a lot of domestic politics, especially when it comes to the auto sector. And for Trump, that seems like that's a red line.
July 9th, 2 days away. I want to turn to the energy market. OPEC Plus agreeing to a bigger than expected production increase of 548,000 barrels a day next month. The move putting the group on track to unwind output cuts a year earlier than planned.
So economically, OPEC might be looking at this and saying, we're going into summer, peak demand. The market could absorb all of this, and we're going to go after market share. At the same time, they could be scoring political points with this administration who continuously talks about the fact that they want to see lower energy costs. The issue President Trump is going to have, of course, is what does this mean for U.S. domestic producers that are saying, at these prices, we are not going to drill, baby, drill anymore.
Crude actually a little firmer this morning, up by 0.75%. Brent crude at the moment, 68.81. WTI, 67.13. Let's turn to Tesla. The CEO, Elon Musk, saying he has formed a new political party called the America Party. President Trump slamming the move.
It's always been a two-party system, and I think starting a third party just adds to confusion. It really seems to have been developed for two parties. Third parties have never worked. So he can have fun with it, but I think it's ridiculous.
Joining us now is Bloomberg's Craig Trudell. Craig, the president thinks it's ridiculous. I'm sure some shareholders do too with this move in the pre-market. Before we get into the politics, let's just talk about the company. Craig, what's the condition, the state of operations currently?
Not good. And we got a fresh indication of just how poorly the company is doing last week when they reported another 13% decline in quarterly sales. So, you know, the vehicle deliveries reported for the first quarter, there was, you know, some question as to just how much of this had to do with, you know, Musk and his politicking and just how much it had to do with the Model Y changeover. That's their most important vehicle. And they did have, you know, all of their factories go down for some time in the first quarter. By the time you got to the second quarter, you had that fresh product, you know, sort of, you know, that arrow in the quiver. And yet Musk, you know, also was, you know, giving investors this notion that, you know, I'm going to turn back to the business now that I'm done with Doge. He has not, you know, done that, you know, as we've seen on a sort of day-to-day basis. He's you know, continues to kick things up in Washington, and now has made himself not only an opponent of the Democrats, but an opponent for the GOP and for President Trump.
Craig, when you look at the data right now for car sales, not just in Europe, but around the world, do you see a brand issue that's unique to Tesla, or do you see an industry problem that others have too?
It's a really important question, and one that is, you know, couldn't be clearer, where, you know, here in Europe, you are seeing consistently Tesla being, you know, down month after month, and industry-wide EV sales are actually quite strong. And it's been a bit surprising because early this year we had, you know, the industry lobbying furiously for relaxing CO2 regulations, right? There was this real concern that the sort of incumbents, the established car makers, weren't going to be able to get their emissions down fast enough. Instead, we're seeing, you know, companies like Volkswagen have a bit of a sort of pickup in electric vehicle sales, while Tesla is really taking it on the nose. And so this is not a case of you know, the industry more broadly having you know, problems with EV sales. You know, I would also point to GM just this past quarter in the U.S. More than doubled its EV sales. And so this is an issue of Tesla clearly having problems with, you know, winning over car buyers and people looking to alternatives, you know, perhaps, you know, for the reason of Musk more so than anything else.
Craig, appreciate your time. Craig Trudell there of Bloomberg. The stock is lower by a little more than 6% in the pre-market. Here's the take from Dan Ives of Wedbush, writing the following. Musk diving deeper into politics is exactly the opposite direction that Tesla investors and shareholders want him to take. Dan joins us around the table. Dan, good morning.
Great to be here.
How much of a problem is this?
It's a huge problem. I mean, like, it's what we've been talking about, you know, here in the show, you know, for months, that you went from Trump administration, Doge, BFFs, Obviously, there was a huge moment. You had to step back from politics, and that's exactly what investors want to see. And now you poke the bear in terms of Trump, and now you're forming a political party. So the point is, I believe you've now hit a point. I think the board's going to have to get involved because this is now over. I think there's a line in the sand that he's now starting to cross, and that's the frustration. As someone that's a huge supporter of Tesla, autonomous, the golden age ahead, you cannot kind of go down this path, and I think that's why the stock's reacting.
Let's unpack that. Board involvement. Describe what that might look like.
Look, I wouldn't say it's necessarily an ultimatum, but, you cannot keep going down this path where, to start a political party ahead of the midterms, I mean, the amount of work, time, and also you alienate potentially, whether it's Republican Party, whether it's Trump. So now Trump goes from obviously a huge supporter to, is that sort of an enemy or blockade? And I think that's why the stock's reacting the way it is, because the last thing you want to see at this point, autonomous, regulatory, that now Musk goes from front seat in the White House to ultimately you become more of a foe.
When you say ultimatum, you mean the board saying to him, if you continue this behavior, you can no longer be CEO.
Look, I think the board's gonna, it's a tricky path, right, for the board. And this is not a board that necessarily has had such a, a huge backbone when it comes to Musk. But I do think, look, investors, there's exhaustion.
Do you want to see a new CEO?
Look, I want Musk to stay CEO as Tesla, because in my view, Musk is Tesla, Tesla is Musk, the biggest asset of Tesla. But this political journey that he continues to go through, I think it just comes down to investors have hit a point where they want him focused on Tesla and AI. And every time that happens, he just continues to go further and further into the political theater.
He might not be just burning bridges in the Beltway. I want to read you this quote from the Wall Street Journal reporting overnight. Because of the Musk-Trump feud, Beijing no longer views the Tesla CEO as a geopolitical asset and will shy away from publicly courting him. Is he going to have problems outside of the United States as well because of his political involvement in the United States?
Look, it goes back to, like, if you just take a step back here, it's like, let's try in a way to almost alienate every aspect of the ecosystem, right? In terms of the core buyer, to now maybe even Republicans, to what you're seeing in China. Look, China, that's the hearts and lungs of Tesla. I continue to believe Musk is an asset there, and it will play that sort of, nice in the sandbox. But it does show you become an enemy or a foe to Trump. What does that do in the political and obviously the geopolitical? And I think that's part. Look, that's part of the issue here, is that you start to go into a quicksand situation where I think in the view of investors, there's really no upside. You can say, okay, if you get midterms and you have some success and he has political power, but that's, independents have never had really success in the U.S., but it's massive risk. That's why the stock's selling off the way it is.
The Amex community is not exactly bulled up on this stock. It's actually very divided. If you take the 12-month consensus price target, the average is about $298 right now, and that's below where we closed on Thursday. How well understood are these risks as they manifest and evolve over the weekend?
Well, I think the risks now, they continue to expand. And I think that's part of the issue is that, okay, here it is, you go back to a few weeks ago, robotaxi, autonomous, Musk 100% committed. Now it's like, hey, over the weekend while eating a hot dog and doing a July 4th barbecue, hey, let's start a political party. Yeah, it's a good idea. Yeah, we're going to do that. So that's, as an investor, it's the last thing and I heard over the weekend, the last thing you want to see is him go down this path. But I think the bigger worry is as he goes further and further down the path, from a Tesla perspective, does that maybe add risk in terms of Trump becoming more of a blockade rather around autonomous and around some of the...
Just describe what that means. What do you mean by that? What could he do?
A big thing is around the federal roadmap in terms of autonomous. I mean, now this is a key few years ahead for Tesla going not just from Austin, but 25 cities over the next year. If you start to put more blockades in terms of things that they need to meet in order to get on the road, if instead of more of a green light, it's a little more of a yellow or red light, that's the worry. That's what the stock's selling off. It's the fear that over the next 6, 12, 18 months, Trump starts to put little blockades in that.
But at the end of the day, the president is looking out for America's interest. If he just does that, it might hurt Elon Musk, but also might hurt the United States when it comes to competition with China.
And that's why we've said the biggest asset when it comes to autonomous is Tesla, because when you think of Waymo's, they're not going to scale at any level relative to Tesla. So when you're competing with China, Tesla and Musk is an asset, no different than Jensen. That's why, look, the hope is at one point, is there some sort of meeting between Musk, Trump? Can they sort of get to some resolution? The problem is every week it gets further and further, and this is not what you want to see. Just think about it in the context of every other tech company, from Nadella, from Jensen, from OpenAI, from Oracle, heading all down the AI path. You don't want to see Musk now going down the political path.
How much time does he have? You've got a price target of 500. In a pre-market right now, we're at 294. How much time does he have to back away from this?
I mean, I think you basically have what I view as kind of like 90 days, 3 months. I mean, I think there's a 90-day sort of, I could see like some sort of ultimatum where if he continues to go down the path, no different than how we view with Doge and Trump, where he basically on that conference call had to back off. This is a, I wouldn't necessarily say a moment of truth, but this is a time now for Musk. He needs to choose. And you can't keep having these one step forward, 2 steps back, 1 step forward, 2 steps back. And that's why the exhaustion is starting to play out in Tesla stock.
Dan Ive of Wedbush. Dan, it's good to see you, sir.
Thanks.
Certainly exhausted by a lot of this. The stock is down by close to 7% in the pre-market with an update on stories elsewhere this morning. With your Bloomberg Brief, back with us, here's Yahira. Hey, Yahira.
Hi, John. We start with the latest out of Texas. At least 80 people have died and dozens more are still missing following Friday morning's flash floods. Water levels on the Guadalupe River rose by 26 feet in just 45 minutes. Officials warn the casualty count will climb with more rain in the forecast. Meanwhile, President Trump is planning to restrict shipments of AI chips to Malaysia and Thailand. Sources telling us here at Bloomberg the move is part of an effort to crack down on suspected semiconductor smuggling into China. The regulation would mark the first formal step in President Trump's overhaul of former President Biden's approach to AI. Meanwhile, here's the latest on TikTok. President Trump says the U.S. will discuss a deal with China today or tomorrow, and he says they already pretty much have a deal. Those comments coming as the information also reported that TikTok is building a new version of its app for U.S. users ahead of a planned sale to a group of investors. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next on the program, solid headline, fragile details.
The story here is not the headline. The market reaction is trading off of the headline, but I think the story here is much more about private payrolls. This is a slowdown.
Up next on the program, the view from Andrew Honhorst of Citi and why he thinks this Fed is going to be cutting rates before you know it. Live from New York, you're watching Bloomberg TV.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Record highs going into the long weekend. Just coming off those levels as we start a new trading week. Equity futures this morning down by about 0.25%, negative by 0.4% on the Nasdaq 100. Under surveillance this morning, solid headline, fragile details.
The story here is not the headline. The market reaction is trading off of the headline, but I think the story here is much more about private payrolls. This is a slowdown and a little bit disappointment on the private payroll side. The broader story here is the slowing in the payrolls that we've seen for some time. I think it's actually confirmed by this report.
It's the latest this morning. The jobs report exceeding expectations, but private payrolls delivering its smallest increase since October. Andrew Honhorst of Citi writing private payroll growth was soft and highly concentrated in healthcare, suggesting hiring continues to cool. Andrew joins us now for more. Andrew, good morning.
Good morning.
That was your headline going into the weekend. Solid headline, fragile details. How misleading do you think that headline number actually was?
Yeah, I think it shows a lot more strength in the headline than what we're actually seeing in the details. That hiring, like you were saying, largely government hiring. It looks like there was a quirk of the seasonal adjustment there that just boosted the overall number. And then you look at the private payrolls, and private payrolls, 74,000, that's an okay number for private payrolls, not a strong number, but really concentrated in healthcare. And you can't drive an economy with just one sector. So you have fragile details.
These are all valid points, yet the market priced out cuts, didn't price them in. Why do you think that was?
I think the market reaction actually makes sense. We were pricing some probability of a cut in July, and this headline number is going to be good enough that that's going to keep the Fed on hold again in the meeting, at the meeting this month. Again, it's not that there's clear evidence here that the labor market is picking up. It looks more like it's slowing down. But is anything falling off the cliff? Does the Fed need to act urgently? Probably not after this report.
It doesn't feel like things are falling off the cliff, but Torsten Slok put out a note about how the warn notices are going up when it comes to the legality of having to be told that you're going to be laid off in the next 60 days. When do you think we will see that unemployment rate really start to rise?
I think we should see it over the next few months, and that's interesting because that's what the Federal Open Market Committee is going to be watching over the next few months as they go into the September FOMC meeting. It's not just the warn notices. I think to me the most convincing data point is continuing jobless claims. These are jobless claims that people are filing week after week. That should be basically a measure of unemployment, and those are trending higher. So you put that together with the warn notices, what we're seeing in some of the survey data, it's all pointing to a higher unemployment rate. And that's why it was quite surprising to see the unemployment rate move lower in last week's jobs report. But in the July report and the August report, I think we'll see that upward travel in unemployment.
How has the president's immigration policies affected what's going on right now in the labor market?
That's part of the reason that there's so much emphasis and concentration on the unemployment rate. We really don't know what the so-called break-even level of payrolls growth is. So depending on immigration flows, you might be able to run 200,000 jobs per month. and have the unemployment rate not move higher, not move lower. Right now, we think that break even is maybe closer to 100,000 jobs per month. You basically need fewer workers getting jobs to keep the unemployment rate from moving higher. But we don't know. We don't know. The Fed doesn't know. And that's why we're just watching the unemployment rate.
We're told repeatedly that college grads are having a terrible time. Do we have to have a bigger conversation about what AI is doing to hiring and what you've described as a low-churn dynamic grip in this labor market, and not just over the last several months, but for quite a while now?
I think there are two things that are going on there. I think that AI story could be part of this. Now, you would think that AI would maybe affect lower skilled jobs first, maybe not as impactful for the new college grads, but probably having some impact, probably a reason that firms are hiring a little bit less, you're becoming more productive using technology. But the bigger overall story is just a weakness that we're seeing in hiring throughout the economy. And I think that's bigger than AI, that's broader than AI. This is firms that are just trying to keep costs down, generally speaking.
So here's the constructive view. Some people watching this morning might say, this is backward looking. The first half of 25 was full of uncertainty. The second half will be full of clarity on taxes already and next on trade. And what you might see are those two issues become a tailwind through the next 6 months or so. What would you push back against that?
Well, on the tax issue, I'm not sure that we're going to get a big stimulus out of the bill that just passed. This is keeping a lot of tax cuts there that were already there. That means that you don't have a fiscal cliff, but we're not adding a lot of new fiscal stimulus to the equation. So I'm not sure on that one. And in terms of clarity on trade, well, we're sitting here talking about letters that are going to go out. Are we going to find something out July 9th? Are we going to find something out August 1st? I think we still have some uncertainty there. But again, this slowdown in hiring happened before we heard about tariffs. This happened before this administration. This is not about politics. It's not about the political cycle. This is about the natural business cycle in the economy.
We hear a lot that right now in the labor market, it's just stasis, basically frozen. Not a ton of hiring, not a ton of firing. But could trade and tariffs, if it gets too cumbersome for corporate America, mean there's going to be layoffs?
Well, if you have a higher cost structure and that's being driven by anything, it could be tariffs, it could be higher commodity prices, whatever's driving higher costs for you, you start to look for ways that you can reduce costs in other places. And one way of reducing costs, actually one of the easiest ways of reducing costs is just hire fewer people, right? Moving to layoffs, that's a bigger decision. We haven't seen that happen in the economy. That's part of why the labor market has been so resilient. But yeah, just cutting back on hiring. And I think that's part of what we've seen firms doing. And remember, higher interest rates are part of that also, right? That's where the Fed comes into this. If you're paying a higher interest cost, one way that you can offset that is by paying less in labor costs, by hiring less.
First cut, September?
First cut, September. It does increasingly look like that's where the committee is headed. Powell's made these statements about watching the data over the summer. And it's not just about the labor market. Labor market is what would give them urgency to cut. It's also about inflation. Inflation has really slowed, I think, a lot more than a lot of Fed officials thought that it would. That's going to give them a lot of confidence.
We might know who the next Fed chair is by September.
Potentially, that's right. The president is excited to maybe announce someone, although I think it will take a little bit of time. I still go back to what Besson said, which was interviews will start in the fall.
Andrea Hoddenhorst of Citi. Andrea, good to see you. Looking for that first interest rate cut in September, believing that the headline number that looks solid going into the long weekend was somewhat misleading, and the details beneath the surface are looking pretty fragile. Equity futures on the S&P 500, not fragile this morning, just a little bit softer. Up next on the program, Ben Laidler of Bradesco, Henrietta Trey's of Veda Partners, the former Trump White House trade official Kate Kalukowicz, and Mike Powell of BlackRock. The second hour of Bloomberg Surveillance is just around the corner.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity, it's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
There's still some uncertainty around tariffs that has to be reconciling.
I think the president wants higher tariffs because he believes in higher tariffs.
If you think that the end game, we're going to have some tariff on the rest of the world.
Over the next several weeks, we'll find out in Q2, how did companies actually respond to higher tariffs?
As long as tariffs are transitory, we're in a good place for the Fed to cut in a couple of months from now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P just pulling back from all-time highs on the S&P 500, down by 0.25%, down by 0.4% on the Nasdaq 100. As we look ahead to this week, just one big important date, the self-imposed deadline of July 9th for trade deals. Now, the big question so far this morning is whether that self-imposed deadline is still actually a deadline and whether the new one is early August.
It looks very fluid, and I think it depends on who in the administration you ask. The president last night put out a truth post saying that at noon there's going to be a number of letters being delivered that sets new tariff rates as opposed to the rates that were set April 2nd, and then we had this reprieve. And at the same time, his Commerce Secretary, standing right next to him on the tarmac, said actually we're setting the rates, but they're going to take effect August 1st. What I have been hearing time and time again from trading partners outside of the United States is that if you are in negotiations with this administration, they have said, we will give you more time past July 9th if we are not there yet, because they are dealing with dozens of countries. What is interesting is how the level of countries is changing, the pecking order. European Union, Ursula von der Leyen had a call with the president yesterday. They seem to be in good spirits. They could potentially ink something, at least some sort of announcement, before Wednesday. Very different from India and Japan, which everyone said out of the gate we're going to be the first ones to get a deal.
Who is at the back of the line? It sounds like Japan. Now, that can change over the next few days. Let's pick out a single name before we get into the conversation on trade anymore. Tesla, down by 6.5% in the pre-market. Elon Musk over the weekend saying he's going to start a new political party. The backlash begins almost immediately.
Immediately, the president said he is off the rails when it comes to this idea of starting a new political party. The issue with Tesla investors, and to Dan Ives' point, at some point he thinks the board maybe has to step in and give him an ultimatum, because they're concerned this will put more hurdles in the way when it comes to the regulation environment, when it comes to autonomous driving. That is their problem with Elon Musk getting more involved in politics.
That's Tesla. I think we need to talk about what it could mean for Washington. It wouldn't take long to figure out just how much deficit spending has been approved over the last 5 years or so with the vote of one person. That's how thin the margins have been down in Washington, D.C., and that one person has been the Vice President of the United States, whether it's J.D. Vance or Kamala Harris. The vote of one person putting trillions on the debt pile in the United States of America, and how just Elon Musk, backing just a handful of candidates, could change the math down in somewhere like the Senate.
You're exactly right. How many times have we seen, you know, that last-minute call, and you see the motorcade come from the Naval Observatory to the Senate to break the tie vote? What you see now with Elon Musk is potentially some people thinking, I agree with some of what he's saying when it comes to deficit spending. I would love to run for political office. I don't have the cash behind me. And maybe he does pick out a few individual people. But what he is saying on X is this massive pronouncement that he is going to make an independent party, which we really haven't seen the heyday of since the late 90s.
Tesla stock in the pre-market down by more than 6% so far in early trading. Coming up this hour, lots to talk about over the next 60 minutes or so. We'll catch up with Ben Laidler of Bradesco as futures slide on President Trump's latest tariff threat, Henrietta Trays of Vader Partners on the White House's tax bill victory, and Mike Powell of BlackRock on navigating policy volatility. We begin this hour with futures sliding ahead of President Donald Trump's renewed tariff threat. Trump saying tariff letters will be delivered starting at noon today. Ben Laidler of Bradesco joins us now for more. Ben, welcome to the program, sir. It's been too long. Let's just get to sort of base case, baseline expectations for the next several days. What are you and the team expected to see?
Well, I'm hoping we see sort of more of the same, right? I guess continued uncertainty, but actually no dramatic changes to this sort of backed off tariff scenario. You know, this does feel a little bit like sort of back to reality. Of course, it never went away. We just forgot about it for 90 days, and markets, you know, ripped off the back of that. And I think we're having probably a predictable reset here.
Ben, let's talk about how that reset might shape global markets. The bias at the start of the year was to look to international assets and maybe leave the US behind. The US has snapped back so aggressively, so quickly. I think people are questioning that all over again. Where do you stand on the issue?
Yeah, I sort of think the genie's out of the bottle on US exceptionalism. I'm not a bear on the US. I think the US is fine, but I am looking for much more average returns out of the US, these sort of typical 10% levels, not the twice that we've got used to in the last couple of years. And I think the rest of the world looks pretty good here. You still, in most of the world, have this sort of double equity and FX discount. The weaker dollar's clearly helping. And I think some of these countries have real silver linings to a potential restart of this tariff war.
Well, when it comes to the restart of the tariff war and you're looking at all these countries, who are you most excited about? Everyone was very amped up and excited about Japan, but they've seemed to take in less of a priority with this administration than they did just 30, 40 days ago.
Look at LATAM, if you want to be excited. Cheapest markets in the world, best performing markets in the world this year. Mexico, one of, you know, a tiny handful of countries that still have tariff-free access to the US. And places like Brazil, you know, low 10% tariff, lots of commodity carve-outs, and a market which would actually probably like more of a slowdown potentially coming in from the rest of the world. So there are, you know, it's a big world. There are definitely markets out there that I think would, you know, could have silver linings here.
It's interesting you mentioned Brazil, because the president was saying that any countries that align themselves with policies of the BRICS could be charged an additional 10% tariff. Brazil is the host country for this week's BRICS summit. Do you think Trump is more emboldened now? It's a question Jonathan's been asking all morning, given the fact that he has had the markets at an all-time high, and he just passed his one big beautiful bill.
We're going to find out. I guess that's the one thing I know with some certainty. But yes, the Trump put is definitely not as strong now as it was, you know, when we were down in the hole, you know, 20%, you know, plus ago. You know, I would like to feel it's still in place. I would like to feel, you know, Trump feels he's in a better place. Does he really need to go through that all again, introduce that level of policy uncertainty, those even greater drags on US growth? You know, I would hope, you know, cooler heads prevail, but who knows? You know, we still have 90% of this administration to go.
Ben, investors feel like they're in a much better place compared to where they were a few months ago. Are companies What are corporations doing now, Ben? And a question we asked in a previous hour, have we established how these tariffs will be handled? Will they be passed on, or will they have to eat it on margin?
Listen, I think companies are just like the rest of us, right? I think this level of uncertainty, even though it may have come down a bit, is absolutely corrosive to decision-making, to confidence. And I think, everything else being equal, that means that you are hiring less people, you are doing less CapEx. And to your question on tariffs, I think companies have shown us, and the margins are there to prove it, they will pass this on. They will pull that pricing lever at every opportunity.
Ben, which economy, which set of consumers do you think is in a better position to absorb that hit?
Well, it's the US consumer that's going to take most of this, right? So the US consumer is in reasonably good shape, but at the margin, this is all slowing, right? So I'm not sure that the US is in the eye of the storm here. I think the rest of the world, whether it's on the economy side with fiscal stimulus in places like Germany and China, or whether it's on the market side with these double discounts on the equity market and the FX, I think international assets and this global rotation has further to go.
Ben, I'd love to get your thoughts on China, because that is something that the president is still working on, more of a bigger grand bargain deal he talks about. At the same time, they have a framework when it comes to export controls and critical minerals. Do you think China is investable?
I think it's definitely investable. We are seeing very strong inflows into Chinese assets. I was just looking at the numbers this morning from the US ETFs, was like 500 million last week into China. 500 million, the week before. So absolutely, the money's going in. This is a very cheap market. I think people are betting there's a deal to be done, and there's enough flexibility on the Chinese side they want a deal, and they have the policy stimulus to maybe offset some of the costs to the tariffs they're having to eat right now.
Hey, Ben, appreciate your time. As always, Ben Lader there of Bradesco. Constructive on global equities, but international assets much more so than, say, the US, which is amazing to see, given the tariff levels we might see develop over the next several weeks.
I know, that's what I find so interesting about all of his comments. Even a place like Brazil, when the president overnight is saying anyone that aligns themselves with BRICS, Brazil is hosting the BRICS summit, is going to get an additional penalty. But I think a lot of countries view this the same way Ben views this, in the sense that this could hurt the United States, but could hurt us even more when it comes to these tariff levels.
They seem to be much more worried about US consumption trends than maybe what might happen to international exporters. And there are some big international names abroad that will have to stomach a lot of this.
A lot of this. And we do know that some of them even went to factories, say in China, saying, you're going to stomach this. And they're saying, nope, you're going to have to do it. And then that comes down to the point we just had the discussion with Andrew Hollenhorst. At one point, does it get too difficult where you're not just saying, we're not going to hire anymore because we have to control some of these costs. We might have to start thinking about layoffs.
Futures this morning, negative by about 0.25%. Pretty calm start to a week. Filled with risk, just one risk in particular, trade, of course, and we'll see if we get over that hurdle later on this week. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. We begin with the deadly flooding in Texas. Rescuers there are still searching for survivors after the catastrophic weather event over the weekend. The disaster killed more than 80 people, including many children attending youth camps. It's feared the casualty count will climb with more heavy rain forecast in the coming days. Meanwhile, Israel is sending mediators to restart talks with Hamas in Qatar after the militant group said it was ready to negotiate on President Trump's proposed ceasefire. The proposal includes the return of 10 living and 18 dead hostages. It's been accepted by Israeli Prime Minister Benjamin Netanyahu, who is set to meet with President Trump in Washington today. And Jurassic World's Rebirth scored the top spot in the holiday weekend box office. The latest installment in the Universal Pictures dinosaur franchise grossed over $147 million in the US and Canada, despite mediocre reviews. The film is the 7th in the franchise, which has taken in over $6 billion in ticket sales since the first release in 1993. That's your Bloomberg Brief. John?
Yahara, thank you. You don't wish failure on anyone, but obviously with that kind of success over the weekend, it means we're going to get Jurassic World 1, 2, 3, 4, 5, 6, 7, 8, right?
I was a huge fan of Jurassic Park, so I'm definitely going to see this.
Sure.
The original, yeah. Maybe I'll just stay home and watch the original again.
Likewise, but don't you want to sort of incentivize some creativity in Hollywood?
Yeah, good luck with that.
Come up with something new, maybe, possibly in the future. We can only hope. Up next on the program, President Trump setting the rates.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
Up next on the program, Henrietta Trays of Vader Partners, live from New York City this morning. Good morning. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
July 9th, just 2 days away, the end of the 90-day pause on the reciprocal tariffs announced on April 2nd. The following day, we'll get some earnings for you. Delta Airlines just around the corner. A week tomorrow, CPI and JP Morgan results. So lots still to come as the week progresses and we start to take a bigger sneak peek of next week. Equity futures on the S&P so far this morning, just a touch softer, no drama here. We're down 1/3% on the S&P. On the Nasdaq 100, we're down by 0.45. Under surveillance this morning, shifting deadlines.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
It's the latest this morning. President Donald Trump announcing letters and tariff rates will go out to trading partners starting at noon today. Trump also threatening an additional levy for BRICS nations. Bloomberg's Tyler Kendall joins us now from Washington for more. So Tyler, let's set things up over the next several days. What can we expect today, tomorrow, and into Wednesday?
Yeah, hey, John. Well, we should say that the administration wants to show some sort of forward progress here, but it's pretty clear that the situation is fluid. Now, our understanding is they're going to send these letters in the coming days, but that they're not going to collect the levies until August 1st. That would suggest to us that there's a 3-week extension when it comes to negotiations. And the Treasury Secretary, Scott Bessent, said as much in an interview over the weekend. He said the administration's playbook here is maximum pressure, in his words, and that they're hoping the letters will light a fire under some of these trading partners to put their best offer on the table. Now, our analysts at Bloomberg Economics say that there's sort of 3 scenarios that could unfold in the next week. One is that we could see some framework agreements announced, such as what we saw with Vietnam, though worth mentioning that negotiators from the country were here in Washington over the weekend because they are still ironing out the details. The second is that we could see those countries that the U.S. feels are negotiating in good faith get that extension, and they could say that they're making forward progress here and they want to continue the talks down the line. Perhaps the EU would be a good candidate for that, and what's really been sort of a reversal in favor when it comes to how the administration views the trading bloc, with it being confirmed this morning that Ursula von der Leyen, the Commission president, had a phone call directly with President Trump over the weekend. And lastly, John, the third scenario is that the administration is going to dictate tariffs to a certain sector of our trading partners. These are the smaller countries that don't do as much trade with the United States. The Treasury Secretary said over the weekend this could be 100 or so countries that face probably that 10% baseline tariff. But it's worth noting that they're trying to pitch those as deals, and that's sort of the messaging that we could expect from the administration moving forward.
Right, we might see that at noon today, according to the president, when it comes to those letters. Tyler, let's sit on the EU for a second. The spokesman said we're at the beginning of the end game, at least for an agreement in principle. How long are these negotiations going to last, even if you ink a framework?
Right. Well, we're expecting it to last really months, and we need to keep in mind that trade deals often do take a lot of time. Take China, for example, which of course is on its own separate track, but that phase one trade deal took 18 months to negotiate. So it is a really ambitious timeline to get this done. In the European Union's case in particular, we're talking about 27 different member states trying to negotiate one trade deal. And we've started to see sort of a splintering when it does come to those trading partners. We had reporting over the weekend on the Bloomberg terminal that some of these nations want to boost investment in the U.S., for example, to try to spur negotiations forward. But then you have another sector of parts of countries that are saying, instead, let's put into effect our retaliatory tariffs, because they don't want to wait around for some sort of negotiation. And that's sort of the tension that we're seeing playing out, because, Anne-Marie, as you well know, they already have $25 billion worth of retaliatory tariffs ready to go to pull the trigger on if they want to immediately, and they're preparing about $100 billion more that could come down the line.
Tyler Kendall with the latest. Tyler, thank you, down in Washington, D.C. More from Tyler throughout the next couple of hours. Henrietta Trace of Veda Partners has this to say: it is our base case expectation that the base 10% tariffs will not come off. We're also expecting the Section 232 sectoral tariffs to be announced in the days ahead. Henrietta joins us now for more. Henrietta, welcome to the program. It feels like 10% might be the best case outcome for many of these trading nations, including the Europeans. What do you think the worst case outcome might be?
Yeah, I think when we look back and reflect on today, in the grand scheme of things, this is going to represent the low point of the Trump administration at this juncture for where tariff rates are going to go. If you listen to what Tyler just explained and where the trade negotiations are, there's no need to delay implementation of tariffs to August 1st unless they're going up. So all those 100 nations, some of them are exposed to 50% tariff rates. But very disconcertingly, the president came out over the weekend and said some of those tariffs could go in at 60 or 70% rates, which would be even higher than the ones he rolled out on April 2nd. And what we're seeing, as in the case of Vietnam, is that they're going to sort of bifurcate whether the nations are shipping things that were made in that country or transshipped. So there's a whole basket of nations in Southeast Asia who are exposed to a blended tariff rate of about 50%, 20% on their own sourced and exported items, and then 40% on things that are transshipped. So we have a 30% effective tariff rate. So that's sort of the direction we're going, and I think we're going to see the sectoral tariffs come on and be negotiated. So things are going up from here, not down.
Henrietta, what you're describing sounds like Liberation Day Part 2. Is the market unprepared for that?
I think the market is trying to operate like this is going to be a nothing burger. We hear the taco stuff all the time, but we are seeing tariff rates go up. And one thing I really want to flag, and I see, Treasury Secretary Bessent on the media tour now talking about the OBBB and these tariffs that are obviously top of mind. But one of the things that he argues frequently is that this is just a one-time hit and not inflationary. And that's inconsistent with the actions of the administration. We've seen tariff rates rise no fewer than 6 times that I could just count while I was sitting here, going into just the first 6 months of this year. And they're set to rise again. That would be a 7th. And then we're going to get 7 different sectoral tariffs. And then we're going to have, 90, 180-day delays in deals with the EU or Japan or South Korea or India. This is a perpetual component, just like it was in Trump's first term, where we got the tax bill done. And we spent the next 3 years raising tariffs, in that case on China and 232s, and I expect to see that again.
Well, 2 things to point out. The Treasury Secretary consistently makes this case that it's not inflationary because it's a one-time price adjustment when it comes to potentially the hit on goods. When it comes to, though, what the president is doing and what you're pointing out, changing the tariff rates a number of times, isn't that how he negotiates a maximalist approach to then de-escalate? We saw that play out with Beijing.
I mean, you de-escalate from 145% to 33%. I don't know how fantastic that is. And they're all stacked on different tariff rates from this first administration. So I think that the general trajectory is tariff rates going up. And then as things pop up, like this BRICS stuff overnight, you're seeing the president deploy tariffs as his most effective bullet in his arsenal. And I think that that's going to continue because it is an incredibly effective bullet. I'm actually writing a note to clients right now talking about how there will be no leash on the president on tariffs until we get into the general election cycle, which is not until February of next year. So we've got another 6 or 7 months of this.
So Henrietta, just hold up, because this is important. You've got business leaders and investors starving for clarity, and some who believe that clarity will come on this issue in the coming months. You're saying, as Anne-Marie has said for quite a while, this might just be a feature of this administration.
Quite right. Exactly so. That's exactly what it was in 2017 and 18. And what I see is almost an exact replica of his first term. You wait to get your legislative agenda accomplished. That was done last week. The OBBB is done. We're not going to be passing any additional legislation. We're going to have to deal with a government shutdown potentially, but the debt ceiling's off the table. There's no need to extend the 2017 tax rates. That we're done on the legislative front. That means that the next 3 years, just like in the Trump first term, will be all trade all the time.
Let's address the backlash to that bill that was passed. The backlash from one individual, Elon Musk, unveiling a new party. Now, Henrietta, we were talking about this about 20 minutes ago. I'm not sure if you missed it at the top of the program, just how much deficit spending has been approved in this country in the last 5 years by single vote margins, and how disruptive a new party could be if they just target some very tight districts in the midterms. How difficult would it be to put that together with only 18 months, not even, left on the calendar?
Incredibly difficult. So what I notice when I hear Elon Musk talk is that he does go out of his way to highlight that there are a couple of Senate seats that you could really be impactful in. That kind of nuanced thinking is really critical. If you're going to deploy independent cash without, the Democratic Party behind you or the Republican Party behind you, you're going to need to be very targeted. And then you can be very disruptive. Think like Kyrsten Sinema, Joe Manchin, Rand Paul, these individual senators who have outsized sway and impact because outside contributors have propped up or created that member. And that's the kind of disruption that Elon Musk could create if you wanted to. I don't imagine that it would be, all of a sudden there's 3 parties represented equally in Congress, but you could really upset the apple cart in key states like committing to spend in Alaska or North Carolina to take on Tillis's vacant seat or Susan Collins in Maine. There's a couple of ways that you can spend money and have it have maximum impact.
Henrietta Trace of Vader Partners. Henrietta, thank you. As always, good to see you. Looking ahead, not just to the next several months, but to the rest of this term.
Rest of this term, and Ben Ladler put that 10% way through the 10% we've already gone through, 90% to go through a 1,460-day administration. And to Henrietta's point, the fiscal agenda is done. There's really not much more they can do. That's over with. Now it's going to be fully focused on trade. What's different from Trump 2 than Trump 1 is he is going after the entire world when it comes to resetting tariff rates. This is not just about China.
It's not just China. It's Europe, Japan, India, and a whole lot more. Equity futures on the S&P negative by about 0.25%. We'll talk more about trade in just a moment. The former Trump White House trade official, Kate Kalukowicz, plus Yahara with your morning movers. Tesla falling as Elon Musk's feud with President Trump heats up once again.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television. Coming into Monday on the S&P 500, two-day winning streak, two-week winning streak. Equity futures pulling back from all-time highs this morning by only 0.25% on the S&P, down by 0.4 on the Nasdaq 100. Check out the bond market, the front end of the curve. The two-year bond yield into Monday higher for 3 straight sessions. Yields up on the week for the first time at the front end in about a month. This morning, we're down a single basis point, 386.97. That's stronger than expected payrolls report, the headline at least. That upside surprise unlocking some higher bond yields going into the long weekend. Yields this morning just a touch lower at the front end of the curve. I want to turn to crude and finish on energy for you just briefly. WTI and Brent, little move this morning, but plenty of action over at OPEC Plus, initiating another boost to supply.
Another boost to supply, and it looks like potentially the market can absorb it. That's what Saxo Bank is saying. In the short term, downside risk to crude appear contained, because not only are they adding more, when you saw the prices that the Saudis are sending to Asia, they've boosted those prices. So clearly the market is able to absorb what they're putting in right now. But that's because we're at summer peak travel demand. And they may be trying to get ahead of what people are saying 2026 is going to look like. Not a time when you want to try to increase that market share.
This is a well-supplied market right now, that's for sure, in the minds of many. Crude down by 0.1%. WTI 66.93. With 2 hours until the opening bell, let's get you some morning moves and cross back over to Yahara for more. Hey, Yahara.
Hi, John. We start with Tesla down 6.4% in the pre-market after Elon Musk launched his new political party. And the way Dan Ives put it to you and Anne-Marie earlier is that this move lower is on the prospect that this could sharpen the divide between Musk and Trump, and it could lead to Trump blocking Musk's autonomous driving ambitions. And of course, this idea that Musk is too distracted with politics at a time when Tesla needs his leadership. Moving on to another automaker, we have Stellantis now down 4.2% on a downgrade by Bank of America to neutral. That's because they are expecting to see a very weak first half report later this month. They say that even though Stellantis is making progress here in the US, it is struggling over in Europe, especially on EVs, according to B of A. And we end with Boeing. This is it's actually up about 0.1%, but it's among a few stocks that we are seeing move as President Trump's July 9th tariff deadline looms. Investors are worried that new trade barriers could drive up costs for the plane maker, which of course relies on a global supply chain, but also that China's retaliatory tariffs could make its planes more expensive than its rivals like Airbus. And I will note that China is a key and growing market for Boeing. John?
Yahara, thank you. Appreciate it. More from Yahara in just a moment, and more on Boeing as well. In about 40 minutes' time, we'll catch up with Sheila Kahyaoglu of Jefferies. On our radar this morning, one of our top stories, President Donald Trump threatening to impose an additional 10% tariff on any country aligning with the anti-American policies of BRICS. The threat comes as the president prepares to send tariff letters starting at noon.
So what's so interesting about this, of course, is everyone thought India was going to get a deal almost immediately alongside Japan, but India is also a part of BRICS. So are they now in the crossfires of the president with any country that is aligning with BRICS, but actually India is in BRICS? There's a lot of confusion. This deadline was self-imposed. It feels very very fluid. You have the president saying he's sending out letters today at noon. You have his Commerce Secretary, Howard Lutnick, standing next to him yesterday on the tarmac, almost giving a little asterisk as the president is talking about tariffs. He's like, whoa, actually, August 1st is now going to be when the tariffs come into effect. So if you are a trading partner, you realize you really have between July 9th and August 1st until potentially they kick the can down the road again.
A lot of people in this market just want to move on. Decent case study for that was last week, Vietnam. They come out with tariffs on Vietnam of 20%. They sound really high, but they're so much lower than April 2nd of 46%. Market just wants to move on. I'm not sure this is what many investors want to see. Drag this out for another several weeks. Extend and pretend. Set something, move on, seems to be what a lot of people have said to us they'd like to see.
Right, but that's not going to be how this works, because even if you come out and say you have a deal, there's still going to be negotiations happening behind the scenes, and we've heard that already from Vietnam officials saying that we're actually still working on trying to make this more concrete. The president almost immediately rushed. You can almost feel the excitement in his truths. He said, we have a deal, I'll be back with the details. Then he came back with the details, and Vietnam said, well, actually, we're still working on some of those details. I think the European Union spokesperson put it best, talking about the fact that Ursula von der Leyen, the president, spoke this weekend. This is the beginning of the end. This means this is going to drag on a lot longer when actually coming to full throttle trade deals. What we see right now is just frameworks and agreements.
Or the end of the beginning.
Yeah.
Because this might take a long, long time. Henry de Trays of Veda Partners with us about 15 minutes ago saying, what Anne-Marie said repeatedly, this is a feature. This is going to be an ongoing feature of this administration, according to Henrietta and others. I want to turn to this story. President Trump is criticizing former First Buddy Elon Musk's plan to start a new political party. The president calling it ridiculous and saying that third parties have never worked in the U.S.
They really haven't worked in the U.S. except in the late 90s with Ross Perot. That was probably the high watermark when it comes to political parties. I think you bring up an interesting point. Potentially Elon Musk can shift individuals in specific districts or specific states. The problem, of course, when you're seeing the Tesla stock, is what does this mean for his relationship with the most powerful, important person, not just in the United States, but maybe in America. I think what's interesting is what this potentially does to him abroad. Wall Street Journal this morning is saying that Beijing no longer views Elon Musk as a geopolitical asset and is going to shy away from him publicly, courting him, which they were doing because he was so tethered to Trump. Now you're going to see a lot of heads of state not want to be associated with him because of this feud he has with the president.
The Tesla down in the pre-market by 6.5%. Dan Ives of Wedbush pretty clear about this. He's bullish the name. $500 price target, outperform rating, all of that good stuff. Very, very bullish on autonomous vehicles, robo-taxis. He thinks the board should step in. That's his opinion this morning.
What's the red line for the board? Because we've seen this feud already. It feels like one step forward, two steps back. There was supposed to be this phone call. They were supposed to make peace and be friends, again, maybe in quotes. What is the red line for the board? Is this political party? Or potentially is this enough for them to say, if you continue on this, then you're going to have to maybe step away?
That's the latest on Tesla this morning. Let's squeeze in some foreign policy. The Israeli Prime Minister, Benjamin Netanyahu, is set to visit President Trump at the White House later today. Trump telling reporters a hostage deal with Hamas could be ready as soon as this week.
Feels like there's some fresh momentum on this. We had negotiators from Israel and Hamas together with Qatari and Egyptian mediators meet over the weekend in Doha to try to formalize an agreement. The president is feeling like he did have this huge victory in the Middle East when it comes to what happened with Iran and Israel, and this would be the final stage. And the president really needs this finalized before he looks at broader Middle East peace agreements. And something we saw in the first Trump administration, of course, was the Abraham Accords. He wants to see another version of that, particularly with Riyadh and Israel.
I think we'd all like to see further de-escalation in the region, that's for sure. That's the latest on Israel and the Israeli Prime Minister's visit to Washington. Let's turn back to trade. Treasury Secretary Scott Bessent saying that some trade partners' tariff rates will boomerang back to Liberation Day levels. Joining us now to discuss is Kate Kalukowicz, the former White House trade official and former senior USTR trade negotiator. Kate, welcome to the program. Is this the beginning of the end or just the end of the beginning?
Well, I think this is President Trump at his best when he's bringing the pressure and supporting his negotiators. I think this is his favorite time of the negotiations, when he can be extremely maximalist. And I think as a trade negotiator, it helps to have a leader like that pushing for the end, pushing for the negotiations to get over the finish line, and providing that sort of threat that helps his team actually tell their counterparts he's serious.
Kate, what determines whether you get a UK outcome, a Vietnam outcome, a China outcome, or something much worse?
Well, I actually think that's quite an important question. And the Vietnam deal sort of shows that there are two different trajectories here. Let's set China to the side for now, because I think that's a separate type of negotiation. But you have a UK outcome and you have a Vietnam outcome. And I think for the list of countries with which the United States is actively negotiating, you see two different pathways here. One for the more developed economies, probably looking for something like the UK got, and those more export-heavy economies that receive those very high tariff rates. Maybe the Vietnam deal reflects what the Trump administration is putting on the table.
Is the Vietnam deal actually done, though?
Well, back to our end of the beginning, you're right, Anne Marie. These are framework agreements, and I think you described it perfectly. The truth announcing the Vietnam deal was, I think, quite gleeful. The Vietnamese, of course, later in time said, we still have a lot of things to work out here. But let's make no mistake, this is a really important outcome. The Vietnamese, of course, were on the hook for very high tariffs. They've been, the recipient of the ire of the Trump administration going back to the first time around the increasing trade deficit, particularly as it relates to China. The longer term play for the Vietnamese, however, is going to be how it manages this very, very challenging place they find themselves between China and the United States. And these will be the details on the transshipment that they're going to have to work out.
When you look at what's coming up this week, the president says at noon he's going to be sending tariff letters out. You have the European Union, the Commission, talking about the fact that the president got on the phone with Ursula von der Leyen. They're looking to get some sort of framework before July 9th. What buckets are different countries in?
Well, I think you've seen the president, his surrogates, talk about this smaller set of nations or economies which are much further along. I think the president had been quite hopeful last week Vietnam would be the first of several announcements that day, and you've seen him signal that talks with India are quite forward, that talks with the EU are quite forward. Obviously, he's been a little frustrated with where things are with Japan, but I think these are the countries that we can expect some outcomes this week if negotiators can get a few of these wrinkles, ironed out.
These are also the same countries, though, that given the fact that they are in these deep talks, will get extensions. And is that what you think Commerce Secretary Howard Lutnick was talking about when he talked about August 1st?
Well, again, I think the president is trying to signal to these countries that they need to stop delaying. He had hoped to have these deals ready last week. I think this new notion of letters going out is really his way of ratcheting up pressure. Typically, when we see tariffs go into place, there is somewhat of a delay to allow importers some time to adjust. So I think we'll still have to see exactly when things are implemented. But I really do see this more as the president trying to ratchet up leverage.
How surprised are you, given the fact that you were a trade negotiator under Trump, that Japan and the European Union have basically swapped fates?
Well, Japan is quite interesting because I think the president was surprised when he got the Nippon Steel deal across the finish line. He probably suspected that would be sufficient to wrap things up. Of course, the Japanese really want to see an outcome on cars, and the president does not seem inclined to deliver that. Then, of course, when you're negotiating with democracies, this is always the challenge. Japan has an election coming up, which constrains its negotiators. So, it is quite shocking, I think, that we've ended up in this place. But this is part of being a trade negotiator with governments which have to be responsive to their own domestic constituencies. Europe, I think, will get across the finish line so long as we continue to have these leader level discussions. As we've discussed before, the European Union is a very challenging negotiating partner because it does represent 27 different countries. And so if you don't get right to the leader level, you don't get right to these big commercial deals, it's very challenging. So if President von der Leyen and President Trump maintain this dialogue, I think we can get that one finished.
Hey, Kate, appreciate your view. Kate Kalukowicz there, joining us on the latest trade push down in Washington, D.C. To Kate's point, the fact of the matter is for the Europeans, to have President Trump set such a high-pressure campaign, to have the Europeans turn around and basically accept, based on our reporting, a 10% tariff without much pushback is quite something.
It's quite something, but also when it comes to the European Union, how long is this going to take? Because to Kate's point, this is dozens of countries with the Commission representing them. This could be very challenging. Domestic politics is going to be hard in Japan. We heard from the Prime Minister of Sheba yesterday. He said we will stand firm because they have an election coming up. So they can't look like they're placating to the United States of America, especially when it comes to two big industries, autos and rice.
If you are just joining us, welcome to the program. Equity futures this morning, so far at least, just slightly negative. We're down by 0.26%. With an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. We start with the latest out of Texas. At least 80 people have died and dozens more are still missing following Friday morning's flash floods in the city of Kerrville, where water levels on the Guadalupe River rose by 26 feet in just 45 minutes. Now, officials are warning the casualty count will climb with more rain in the forecast. Meanwhile, Iran's supreme leader, Ayatollah Ali Khamenei, appeared in public this weekend. According to Iran's state media, it was his first appearance since the 12-day war with Israel last month. After weeks of sheltering in a bunker, the New York Times reported Khamenei attended an annual Shia religious ceremony held at his compound. And OPEC Plus agreed to a larger than expected production hike for the fourth straight month. The group increased supply by 548,000 barrels a day for August, citing summer demand as reason for optimism that the extra barrels could be absorbed by the market. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira in about 30 minutes' time. Up next on the program, boomerang tariffs.
We're going to be very busy over the next 72 hours. Then on August 1st, you will boomerang back to your April 2nd tariff level. So I think we're going to see a lot of deals very quickly.
Up next, we'll catch up with Mike Parle of BlackRock, live from New York. You're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Live from New York City, welcome to the program. Equity futures so far on the S&P. No drama. We're down 0.25%. We're down by 0.4% on the Nasdaq 100 as we come into this week at all-time highs. Under surveillance this morning, boomerang tariffs.
We're going to be very busy over the next 72 hours. President Trump's going to be sending letters to some of our trading partners saying that if you don't move things along, then on August 1st, you will boomerang back to your April 2nd tariff level. So I think we're going to see a lot of deals very quickly.
So here's the latest this morning. Stocks falling as U.S. trading partners rush to finalize trade deals ahead of President Trump's Wednesday deadline. Mike Powell of BlackRock writing, as macroeconomic and market uncertainty persists, it's time to reimagine alpha. Mike joins us now for more. Mike, good morning.
Good to be here.
It's good to see you, sir. We'll talk about various trading strategies and the ones that have worked so far this year, but let's just start top down, super macro. What are you and the team expecting this week?
So I think the bottom line is we see this week as part of a longer term picture where a lot of trade policy is going to get made, but there's going to be some twists and turns in the road along the way. I think as we heard from Secretary Bessent, August 1 is going to be a pretty relevant point in time. This week's important, but I think what we're looking for is, a lot of discussion, a lot of frameworks getting announced, but this week is not the one focal point in time.
We've had some guests come on this program. Jim Carroll of Morgan Stanley comes to mind, who believes the second half of 25 is the half of clarity, certainty. If the first half was uncertainty, the second half is clarity. Do you share that view?
I mean, I think on a relative basis, that's absolutely the case. I mean, the first half of 2025 was peak uncertainty. If you look just in the last week, we've gotten clarity on what the fiscal policy picture is going to look like, likely for the balance of the Trump administration. And I think as the days and weeks accumulate, we're going to get greater certainty around what the trade policy posture is going to be, country by country, but globally as well.
You mentioned August 1st. Can you believe any of these deadlines if they just keep moving and they're self-imposed?
Well, I think that's why John's prior question is exactly the right one. It's all about the direction of travel, of uncertainty. Is there any fixed point in time where all of this is going to be settled? I wouldn't necessarily bank on it, but is the direction going to be towards greater clarity, greater certainty, more frameworks, more stability? That also seems pretty likely to be the case.
Most people were thinking it was going to be 10% baseline tariffs across the board, basically a ring around the United States. But then the president came out talking about Vietnam, and they have a much higher tariff level. Are you expecting some countries to get higher than 10%?
So I think Vietnam is an interesting case, and I thought your prior guest kind of really got at it. I think regardless of who was in charge in Washington, this issue of Chinese transshipment, China as using third countries as a jumping off point for trade would have been a contentious one. And I think Vietnam is kind of one of those countries that's really in the focal point. I mean, I think what we saw announced last week was 20% tariffs, but 40% on Chinese transshipment. And I think that what it gets at is there's this issue of, are countries like Vietnam going to be a hub that's a jumping off point for access to the U.S. market? And how does this U.S. administration think about both striking deals that matter strategically with countries like Vietnam while also being really focused on some of the issues like around Chinese content, Chinese transshipment that are important for President Trump and frankly would be important regardless of who the U.S. president is.
You have a unique perspective because you sat across these people just a year ago, especially the European Union. Are you surprised by how quickly they've changed their tune when it comes to the Trump administration?
Like I said, I think one of the things that's noteworthy and one of the things that I think we expect is this is going to be a path with some twists and turns. And I think markets are expecting that. Markets are, counting on it even. But last time I was here in the studio, we talked about the path with respect to Europe, that path being a pretty challenging one. I think we expected the path that Japan would be more straightforward. Here we are 6-7 weeks later, and it's just the reverse. But I think that highlights that there's a direction of travel. That direction of travel is towards greater clarity, greater certainty, but the twists and turns are going to take us to some unexpected places along the way.
Who has to stomach the tariffs? That's the clarity we really want here. Is it the European exporter, the US importer, the US consumer?
What's your base case now, and what are you looking for to some kind of guidance on that very important issue?
So in terms of the macro outlook
well, let's try and decide who's paying the tariffs, who has to stomach this. Whether it is the US importers, which by definition will have to, but I want to understand who's going to burden the cost. Will it be the European exporter, the US importer, the US consumer, and then try and get our hands around this issue of the US versus the rest of the world when it comes to equities?
Listen, I guess I'd say a couple of things. One, you know, what's clear, and we hear this from the Fed and other economic forecasters, is this is a negative growth shock. This is a positive shock for price levels. That's true in the United States. That's generally true globally as well. So everybody's going to bear the burden of this to some extent. I think one of the things that's been surprising has been the degree to which we haven't really seen this shock yet play out in terms of the price data or in terms of even the activity data as well. And I think what that reflects is, in some ways, the uncertainty that we've seen has two sides of the coin. One side has been huge swings in market sentiment that have really characterized the first half. The other has been corporate leaders, real kind of actors in the real economy being frozen into place. And yes, that's true in terms of no new capex or limited new capex. That's true in terms of limited new hiring, but it's also true in terms of cautiousness on raising prices, cautiousness on doing anything irreversible with respect to their workforces. And that's because it's a pretty uncertain environment, and doing things that are fixed and locking them into place is not what they want to do. So again, I think it's important to bear in mind that there's a lot of uncertainty out there precisely because actors in the real economy have wanted to pause to see where we're going. And I think we'll get more clarity on that in the back half of the year.
Investors haven't paused. We've seen massive reversals in this equity market, particularly here in the United States. What strategies are working right now? And what strategies do you think will continue to work through the rest of this year?
Yeah, so I'd highlight two things in particular. You know, one, on balance, we still prefer the U.S. equity market to other markets globally, you know, and I think that requires that you kind of hold two things in your head at the same time. Yes, the U.S. is the source of a lot of uncertainty. We've been talking about that. And yet at the same time, the U.S. is also the single biggest destination still for dynamism, innovation, resilience. And that's particularly true in the U.S. corporate sector, particularly true in the technology sector in particular. Those exposures that really get you access to AI, the technological transformations that we're seeing, that's a U.S. story, and that's one that we continue to think investors should get exposure to. The other would just be to say, you know, this is a very uncertain macro environment. Taking big swings at the bat in such an uncertain environment around making big macro calls, that's a hard thing to do if you're an investor. Finding strategies that are going to be primed to outperform, that are more market neutral, that aren't taking big swings in the bat, things like systematic strategies that can deliver alpha in a bunch of different types of market environment and provide liquidity while they're at it. Those types of things that are maybe a little less focused on the macro, a little more focused on delivering alpha in uncertain environments, those are the types of things that we think portfolio managers are really capitalizing on.
Mike Parr of BlackRock. Mike, appreciate it. Thank you, sir, for sharing some of your thoughts on policy and what's working right now. Up next on the program, Kelly Kaminsky of Alpha Simplex, Sheila Kahlo of Jefferies, Stephen Stanley of Santander, and Kathy Jones of Charles Schwab.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign and Central Portugal, and this is Bloomberg.
The fact that the unemployment rate is going down is something that, of course, is quite surprising.
It feels like a lot of optimism has been priced in the market, but we do expect a soft patch later this year.
The story here is not the headline.
If the labor market's okay, their urgency to cut goes down.
Base case, we have them not cutting. Certainly July is off the table.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Just a nice, quiet summer Monday to kick off a trading week. From New York City this morning, good morning. Your scores look like this morning. All-time highs into Monday. Equity futures pulling back by just 0.2%. We're down by a third on the NASDAQ 100 as we wait for the self-imposed tariff deadline of July 9th to come up quickly, just 2 days away, blurring the lines over the weekend as to just what the deadline actually is.
Feels like we're on parallel tracks, right? Because you're saying it's quiet, but at noon today, the president's talking about the fact that the tariff letters are going out. Is he going to share them with the rest of the world? We still don't have the language when it comes to what they agreed upon with China. And then at the same time, the Commerce Secretary said rates are going to be set, but they don't come into place until August 1st. And what I continuously hear, as I heard from the Swiss trade team, is that this administration was pretty honest with them. If we are in discussions with you and we're not done by July 9th, you'll get an extension. So who's getting a letter? Who's getting an extension? Who's getting a higher or lower tariff rate from April 2nd, Liberation Day? A lot of questions to be answered.
A lot of people just starving for clarity. We've said that a few times over the past few hours or so. Mike Powell of BlackRock saying that's exactly what you're getting on taxes in the last week and on trade maybe in the next several weeks.
So what he's saying is he can't pinpoint an exact date when potentially some of these deals will come to fruition, but it's the direction of travel. The direction of travel has been a maximalist approach from this president on Liberation Day, April 2nd, a reprieve for when negotiations are happening, and then potentially you will get some sort of deals. I think what everyone has been really shocked about was how Japan and the European Union have seemingly switched places. Japan was going to be first out of the gate. Well, Japan has an election coming up. So it's a little bit challenging for them to make a lot of these concessions. And the European Union, I think, got the message, you're on the back foot and you're being left behind. And now we've been quickly rushed to the start of the queue.
Max Kentner, HSBC, publishing just moments ago. To us, the big story in July is not this week's tariffs deadline. It's the start of the reporting season. Delta Airlines this week, JP Morgan next week. He thinks the bar is low. Says the following: any dip this week has to be bought very quickly. This market's seen a massive reversal since the lows of April, just like that, very quick.
And what's going to be so interesting about when it comes to earnings season is how much is any of this impacting the U.S. consumer? Are they still going out? Are they still spending? Are they still traveling? Or are tariffs starting to bite?
Equity futures this morning on the S&P just slightly softer. We're down by 0.2%. Coming up this hour, we'll catch up with Katie Kaminsky of Alpha Simplex as trade tensions weigh on markets. Sheila Kolu of Jefferies looking ahead to airline results. And Kathy Jones of Charles Schwab as traders push out rate cut bets. We begin this hour with stocks pulling back from all-time highs as President Donald Trump reignites trade concerns. Katie Kaminsky of Alpha Simplex writing equity trend signals are still modestly strong given the volatility and uncertainty in recent months. Katie joins us now for more. Katie, welcome to the program and good morning. It feels like sentiment is quite one-sided now after the massive reversal over the last several months or so, yet people still come on the program and say the pain trade is higher equities from here. Do you agree?
I would have to agree that that's what we're seeing, especially in the market data. What was interesting, though, is we did see a little bit of a pivot last week where you saw small caps and perhaps more domestic focus being in ahead. And so I'd say that, you know, the general theme has continually been a little bit more pro-growth and positive for equities, which is something I wouldn't have guessed a few weeks ago in particular.
Katie, you're seeing that in equities. Can you say you're seeing the corresponding thing in the bond market at the same time?
Definitely not. I'd say that the bond market has been very tricky this year. We've seen very mixed signals across different parts of the curve. We've definitely seen short signals on the long end suggesting that yields need to be higher over long term. That may suggest some uncertainty about where rates are going to go over long horizons. But in general, it's been very tricky to trade the bond market recently because there's just been this push and pull between when are rates going to be cut and also just, you know, in general, what are the impact of all these macro themes on fixed income given this?
Are you surprised the bond market didn't get a vote on the One Big Beautiful Bill?
Good question. I mean, I think you haven't seen that much movement. You are seeing some steepening as well recently, like particularly today, you're seeing that as well. So I'd say that, you know, the bond market is not voting yet. It definitely voted on what was going on in Liberation Day. So I think, you know, we just have to wait and see when, you know, bond investors are really voicing their opinions. But really right now, very mixed in fixed income.
Do you think bond investors are going to be paying close attention to this deadline this week, or they feel like it's self-imposed and already the administration has signaled that a lot of these trading partners are going to get more time to really work out the agreement with the United States?
Well, I mean, if you look at just how much movement you have today and how the market has responded to recent events, it's almost that the market is sort of shrugging off some of this news because nothing is really a big shock. It's everything that we've been discussing along the way, and there's been continual backtracking and back and forth. So I think people are waiting to know the real results before they start positioning themselves for the impact of those potential trade decisions.
Katie, in the meantime, what's working in the commodity market?
Not much, I would say. I mean, I'd say that commodities have been up this month, but there hasn't been big swings. Obviously, people have been following oil and energy in general. But when you look at things like gold, which had also been pretty much on a tear this year, it has been sort of stagnating some as well. So I think, you know, looking for that demand increase that might potentially occur because of having better, stronger growth is something we're kind of seeing right now this month, that commodities have been up, but it's not particularly strong yet, but it's the potential for a trend going the next few months.
Katie, as I listen to you talk about commodities and fixed income, it just sounds like you're seeing convictionless markets in certain asset classes. Would it be fair to describe them as that?
Precisely. I think what we have seen is strong conviction in equities, a weak dollar, but everything else has been kind of wavering around in sort of anticipation to understand the impact of these trade negotiations, but also just sort of, is the U.S. economy strong enough to actually follow through with this narrative? And that's why I think other asset classes are really really waiting and sort of treading back and forth.
Katie, do you find that difficult to reconcile? While we are seeing that conviction in places like equities and in foreign exchange, where you're not seeing the same thing elsewhere?
Definitely so, but I mean, I think these are just at different time horizons. I think equities move quickly. I think the bond market needs a little bit more clarity on multiple economic factors, such as trade, as well as, you know, the overall health of the U.S. economy and the job market. And those are a lot of themes to reconcile, particularly with a Fed that hasn't moved yet. So I think bonds doesn't surprise me, but commodities, I think they're sort of in the wake of what, you know, I would have expected them to move more just with the tariffs themselves, just fundamentally, but we still haven't seen that yet. So that, I think, helps investors be less worried about this inflation concern or other concerns related to trade in the short term.
Stuck in limbo. Kelly, appreciate the update. Kelly Kaminsky there of Alpha Simplex on the different tone we're experiencing in both equities, bonds and commodities alike. This morning, equity futures erasing losses. We're down by about 0.2%. Some more clarity, hopefully, on the trade front in the next few days.
Potentially, we can get more clarity at noon. The president saying there's going to be a number of letters sent out to these trading partners setting new rates. Basically, this was your rate April 2nd. This is the new rate we decided to readjust for. And people are expecting that. What's going to be interesting, what happens with the main trading partners. Where are they on the European Union? The EU thinks they're going to get a framework before July 9th. That is a complete reversal than what we were talking about just 2-3 weeks ago. When I was with the president in the Netherlands, the European Union was saying they were going to retaliate against a 10% baseline. Like a snap, that went out the window. So they clearly want something done. And Japan and India, of course, also going to be incredibly important.
We explored this briefly with Kate Golubkowicz about 30 minutes ago. She, of course, was a trade negotiator under the president's first term, way back then. And she made the point that the deciding factor that goes into whether it's a UK outcome, a China outcome, a Vietnam outcome, I don't think is well understood at this point. What determines what kind of outcome you actually get?
I think it depends on what the president is looking for with each trading partner. Mike Pyle talked about transshipping when it comes to China. That was really important when it comes to Vietnam. When it comes to the UK, I think also part of it was timing. They want both parties really wanted to get to yes. And they were willing to sacrifice, definitely on the UK side, something to get to yes, because they've been trying to get a trade deal with the United States for years. When it comes to China, though, it's really difficult where we are. It feels like we're only taking the first step of a very long road when it comes to some sort of bigger agreement between the United States and China.
Slow start this Monday morning, expecting it to kick off as the week grows a little bit older, to pick up when we hear from the president in the next several hours, hopefully, on which letters he sent and to whom, and what kind of tariff levels we could see in the next several days. Let's give you an update on news elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. We begin with the deadly flooding in Texas. Rescuers there are still searching for survivors after catastrophic flash flooding over the weekend. The disaster killed more than 80 people, including many children who were attending youth camps. It's feared the casualty count will climb with more heavy rain forecast in the coming days. Meanwhile, the Trump administration is preparing to send tariff letters, as you were just speaking about, to dozens of countries, with the administration's 90-day tariff pause set to expire this Wednesday. Treasury Secretary Bessent telling American media moments ago that his mailbox is full of new trade offers, and we'll see several deals announced in the next 48 hours. And President Trump is planning to restrict shipments of AI chips to Malaysia and Thailand. Sources telling us here at Bloomberg the move is part of an effort to crack down on suspected semiconductor smuggling into China. The regulation would mark the first formal step in President Trump's overhaul of former President Biden's AI approach. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 15 minutes' time. Up next on the program, the morning calls. Plus, Sheila Kahulu of Jefferies looking ahead to airline earnings over the next several days or so. That conversation up next, live from New York. You're watching Bloomberg TV.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening about 1 hour and 16 minutes away. Equity futures on the S&P 500, negative by just 0.2%, down by a third on the Nasdaq 100. On the Russell this morning, softer by 0.3%. That's the price action. Let's get you some morning calls. Kicking off first with William Blair, downgrading Tesla to market perform, citing headwinds from President Trump's big, beautiful bill. That stock is down by 6%. Your second one comes from Raymond James, double downgrading Wells Fargo to market perform, saying the stock's favorable fundamentals are already reflected in its valuation. That stock is down by 0.7%. And finally, UBS lowering its price target on Delta Airlines to 63, looking for an inline second quarter earnings report. That stock is positive by 0.25%. Let's stick with Delta. Earnings due before the opening bell on Thursday. Sheila Kahlo of Jefferies keeping an eye on travel demand this summer, writing, "We observe that while passenger counts remain below last year's level, the gap has been narrowing." Sheila joins us now for more. Sheila, good morning. Good to see you.
Good morning.
Let's go back to February. February was when the warning started, and it started from Delta Airlines, warning about things like DOGE, consumer sentiment, air aviation issues as well. What do trends look like since the start of this year?
It's very hard to cherry pick these airlines. I think they all have an uphill climb, to be honest. What we're looking for is sequential improvement, Q1, Q2, Q3, Q4. Q1, the exit rates in March were down mid to high single digit for domestic mainline cabin. That's pricing. We're assuming some improvement, but still down about 3% in Q2, and then some improvement as we exit the year up. So we have an improvement priced in, but I think trends are stable at best, and we're seeing discounting in mainline cabin in the U.S. and Atlantic.
Are you seeing that at premium and budget and premium?
Mostly in the budget, in the mainline, in the back of the cabin. And Q2 is a big quarter. It represents about 45% of EPS for airlines. So these trends being in line to stable to March is not uplifting.
Have you seen demand, though, continue when it comes to premium cabins and business class?
It seems like it is for now, but we're seeing trends pretty stable. There's really no data source out there, but we're not seeing improvement. Even with TSA volumes at peak in June and over the weekend, they're only up 1% year over year. TSA volumes for travel are flattish, so you're not seeing consumer really improve.
When it comes to consumer concerns, how much is tariffs lingering for the consumer as well as for the airlines?
I think unfortunate for Delta, they're going to report again on another tariff day. So I think that still lingers, and you're seeing corporate hold back a little bit. So I think you'll see more of the same. An improvement from the March trends, but certainly not a big improvement in Q2, which represents the biggest quarter, and exit rates for Q4 are already pricing in some positivity.
How difficult is it for, say, Delta, they're going to be reporting potentially on a tariff day, for them to talk about this uncertainty when the goalposts seem to be moving out of Washington?
Yeah, I think, we've seen a big move in airlines, up 15 to 20% since April. So they're already pricing in this improvement. So hence why we prefer our commercial aero coverage rather than our airline coverage. Because I think you still have some downside risk to the airline names.
I think in the tax bill, there was $12.5 billion set aside for the overhaul of air aviation safety. Talk to us about that. Can you calculate just how much the consumer has held back because of these aviation issues over the last year?
There was some book away with the incident in D.C. For American Airlines. Similarly, Delta saw that too. So you see, pockets of holding back, but I don't think I think it's more of a macro concern that airlines have and corporates have that are holding them back.
Well, let's pick out Newark and let's pick out United Airlines. I know a lot of people, and this is just sort of anecdotal conversations that we've all had. We've had the same conversation, avoiding Newark. because they don't want to see their plane cancelled because of aviation
I think
issues
we could get
and air
back to
traffic control.
Scott Kirby, I think over the weekend tweeted, or whatever it is, on X, said Newark was the best airport in June, and it's true. They had the lowest cancellation rate